I'm not really concerned at all about inflation staying too high.
You still do have inflation that's above target, but I think inflation risks have really dissipated.
Inflation expectations are slowing down with the economy.
You see slower growth, which is a necessity to cool inflation.
The restrictive aspect of policy is working. I think we're going to see a moderating inflation.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Welcome back. Good morning. This is Bloomberg Surveillance ahead of a key inflation reading in the U.S. The Sages said as follows. We get CPI in about 2.5 hours. Traders are heavily positioned for it to support the soft landing thesis. The S&P 500 has just had its biggest four-day rally since November. In the past week, Apple is up almost 6%. NVIDIA is up 17%. AMD is up 10%. Meta, 8%. Danny, are we back to complacency?
Well, it certainly feels like everything is turning up dovish. This huge, powerful rally that maybe just gets another leg overnight into today's session, with CPI in the UK being soft, with the RBNZ cutting too. The one good thing maybe about yesterday's powerful rally, even though it might have front-run CPI, is that it happened when the yen was also appreciating. So maybe this dangerous cross-asset link has been broken. So normalcy for now, whether it holds is a different question.
Well, there's this real issue here of whether we've essentially priced in the soft landing globally, whether we're getting the idea of a dollar that's softening, weakening versus currency globally, simply because the consumer can keep upholding spending even as inflation normalizes and we get some price stability. Anne-Marie, we've been talking a lot about consumer appetite, their ability to spend. We've been talking to a whole host of travel executives. Today, we've got Tony Capuano, the CEO of Marriott, on the same topic.
Yeah, it's really the question is how resilient is the U.S. consumer and how bifurcated it is. And what Tony was talking about, the CEO of Marriott, and their earnings, they say they have real resilience on the upper end. There's still this appetite on the luxury end to travel, while Home Depot is talking about this deferral mindset. Potentially these consumers have the money to spend, but they're waiting. They want to see where interest rates go before they go out and make those big purchases. So we know that CPI is going to matter a lot to the Fed today. Raphael Bostic said yesterday they need just a little bit more data, but politically it matters. This is the first of 3 prints we're going to get for the U.S. election, and inflation has been top of mind of voters.
So this is really one of the big conundrums for the Federal Reserve. The economy looks like it's okay. Consumers have plenty of money to spend as long as they are wealthy enough to have fat paychecks and fat bank accounts that have been bolstered by higher rates as they are. How does the Fed take this at a time where 2-year yields, Danny, have fallen by some 30 basis points over the past month in August just alone? You look at the euro, it is the strongest going back to the beginning of January versus the dollar, all hinging on a Fed now expected to cut rates by more than 100 basis points before year end.
And just on that alone, just on the market moves, the Fed looks so offsides, which will be fascinating to hear if we do get a softer print, if they come more in line with the market's thinking. To your point, Anne-Marie, Bostic yesterday, we want to be absolutely sure. I'm willing to wait, it's coming. I want to see a little bit more data. We need to make sure the trend is real. That is not a Fed debating between 25 and 50 basis points. That is a Fed debating whether to cut it all.
Well, Stephen Stanley overnight was talking about how actually Santander has a 0.3% increase in their model and how that can be completely different for the Fed. And while everyone is still focused on this 25 or 50 on September right now, there are still people in the Raphael Bostic camp that are talking about, well, is it September, November, or December?
And we have someone who's going to be coming on the show and saying the real risk is reacceleration of inflation, not the potential risk of the consumer falling off a cliff. We've got a great show coming up. Marvin Lowe starting us off of State Street on why the Fed can remain patient, sort of to the point that you were just talking about, Anne-Marie. Mike Shepard of Bloomberg, as the DOJ reportedly considers a bid to break up Google. And don't miss this, Justin Dercole of ISO-mts, on why he sees signs of a re-acceleration in inflation. If you want the Fed to cut rates by more than 100 basis points, he thinks maybe you're looking at the wrong stuff. We begin with our top story. Stocks on pause awaiting U.S. CPI data at 8:30 Eastern. Marvin Lowe of State Street writing this. Every data point is live, and policy expectations will be volatile around each of these data points. By our estimation, there is no reason for them to think about 50 basis points in September, nor is there any reason to rush into a November cut. Marvin, swimming against the tide, you're joining us right now. We're back to Goldilocks. Everyone is pricing in more than 100 basis points of rate cuts. Why are you pushing against that?
You know what? We're not really seeing the degree of hysteria that the market had thought we were in, a week and a half ago. To get to 4 to 5 cuts, which is how the market moved in a very, very short order. You've got to see a recession that's very, very clear to both you and the Fed. And we just don't see that data. And, certainly the volatility in the market was scary, but it was isolated to, parts that were overextended. And we knew that they were overextended.
That said, we're seeing some really clear signs that consumers, particularly those who are not at the very upper echelons of income, are struggling. They're starting to push back. You hear this in the commentary from pretty much every single company. No recession calls for the most part, not very many anyway, but definitely weakening. How do you sort of discount the idea that the Fed has an opening to really get ahead of some sort of more material slowdown because inflation is coming off the boil so significantly?
Yeah, I mean, that's the eye of the needle for sure. There are stresses in the economy. We've seen those stresses really get more acute for certain income groups over the last couple of quarters. The restrictive aspect of policy is working. Transmission is different this time. We still have a lot of wealth. Everything that we talk about in terms of Goldilocks and in terms of the rebound, if you will, in a lot of these stocks is creating wealth for certain parts of the economy. Having said that, it's not widespread. So that's what really gets me comfortable that the Fed will start the process. But again, the market is ahead of itself if it thinks that it needs to really accelerate that view.
When we say the market's ahead of ourselves, Marvin, we have to just be talking about bonds at this moment because stocks did a big old rally back to nearly where they were at the start of the sell-off. JPMorgan points out that overall the market sees a third of a chance that we will get a recession, while equities are just pricing in a 1 in 5 chance. So if bonds are wrong, Marvin, are stocks right?
You know what? I think that the equity investors took the opportunity to buy stocks that got cheap. There was a certain amount of momentum that was in the market. We took off some of that froth. Maybe we got a little bit over aggressive. But again, yesterday it was, a bit more widespread, but it was the same leaders that were driving, the rebound, if you will. And those become the easiest names to own when you're worried about growth slowing. This is quality growth that once again is the story that's driving a lot of these valuations.
So take me to this future, Marvin, where the Fed starts this normalization process. They start talking about it at Jackson Hole. The bond market, as you say, is already there and maybe past that. What is the reaction in the equity market? Is what you're describing a blueprint of what we should expect when that conversation begins?
I do think that the soft landing, which went by the wayside over the last couple of weeks, becomes part of the discussion again. I think we're going to see a moderating in inflation. PPI was a good start to it, but there were parts that made you think that it might not be as aggressive of a disinflationary trend going into the fall. That's all fine for equities, particularly companies that can demonstrate that they've got a moat that they could defend from an earnings perspective. The Fed will begin laying the brickwork that they're going to start normalizing rates, but they're in no rush. That's not necessarily bad for valuations. I think what we need to do is put intersections between liquidity, between the soft landing, and really between politics, whether it's geopolitics and or U.S. elections into the fall. So, I don't think that it's going to be completely smooth sailing going into the end of the year. Kind of having said that, risk is still somewhat supported in here. And, make sure you're buying the quality parts of that story that you like.
Marvin, what could upend your belief that we are headed to a soft landing? Is it a data point or is it something like you just mentioned, a geopolitical event?
You know what? I don't think we're going to get a data point that's going to change the story over the course of the next, let's say a few quarters. Whether or not all of the data moves back towards 2% as convincingly as the market expects it by the middle of next year, that's something that we could debate in a couple of quarters. I do think geopolitics are something that, in terms of how asset values are incorporating it, are telling different stories. I do think that some of the geopolitical concerns made their way into the risk market yesterday, but they didn't really show on the equity side of things. So, people are picking, if you will, the best parts of the stories that they want to hear.
Do you think the market right now is underpricing what we are seeing in terms of geopolitically in the world?
Yeah, it's always hard to put a valuation number on what's going on. Again, I think the fact that rates could be showing some of those concerns, but other risk assets don't, make me think that there are certain parts that are underpricing it.
Just to sort of put this all together, you started by saying that the Fed really didn't have to cut so aggressively. You didn't really see a case for a 50 basis point rate cut. You talk about how there are some opportunities to buy the dips. You wrote in your notes, don't fight the rally in duration because it's a pretty powerful one. Do you think that if the Fed does cut rates more aggressively, that could actually disrupt the soft landing that we're seeing right now?
Yeah, for sure. You know, why, and you and I have discussed this, and we've discussed this on the show, why you cut rates are really, really important. If the Fed starts to think that there's 50 basis points are needed because the economy is much weaker than maybe some of the data that I'm looking at, you have to be concerned with that. Kind of having said that, if it's based on normalization, if it's simply based on disinflation getting more aggressive, the market can interpret that well. And, you know, I guess that's the bid and the offer based on kind of what we do. Having said that, you know, we still don't think that they need to rush. And everything that we've heard from the Fed is that they are still patient around that.
Marvin, I want to get a better idea from you what that feedback loop looks like if the Fed does cut aggressively, in which you say could lead to the end of that soft landing. Is it people expecting a recession, so there is a recession? Is it corporates pulling back? What actually is the mechanism for that playing out?
Yeah, you know, I think the labor market is still front and center. That's kind of what really drives whether people feel good or not. You know, are they sitting? Are we still able to talk? And I'm still at my same seat at State Street. You know, that's an important part of the discussion. If we do start to get confirmation that the weaker prints that we saw on the labor market last month leads to potential job losses, larger job losses, I think that that ultimately changes the psyche. Companies will adjust quickly. You know, we heard from the small business survey yesterday, and there wasn't that concern. So, you know, again, it's packaged well, but yes, it's going to be labor market. It's going to be companies that are responding to a significantly weaker labor market. Neither of those are within the data prints that we're looking at right now.
Marvin Lowe, always a pleasure to have you on. Marvin Lowe of State Street, thank you so much for starting us off today. It really is sort of the key question of where the balance of risks is. And frankly, Danny, we get some pretty aggressive views on both sides, with some people are thinking at you, Neil, bounding the table and basically saying, you know, we need to cut right now, and other people saying that would be the error, premature cutting.
Right, especially when you look, as Marvin mentioned, small business confidence at a 2-year high, Atlanta GDP Now tracker at 2.9%. Payrolls are still above 100,000. Economists, for the most part, even though they've had a recent patchy history about predicting these things, see recession odds at about 30%. So you just look at that list and say, how could you get aggressive cuts? Maybe the way you get cuts is something, again, like the RBNZ that said it's just low risk to cut right now, and it's an easy decision to do.
I have to say, Anne-Marie, I don't understand this market, though. I don't understand the response. Think about Home Depot yesterday, right? Think about what they were talking about in terms of a consumer pulling back. Those shares, which were down some 5% early in the market, end of the day up almost 1.25%.
Well, because what Home Depot is saying that they're deferring, these consumers are deferring. They will, once the Fed, to Neil Dutta's points, gets on with it and starts cutting interest rates. But it's difficult because you look across the landscape, and what seems so apparent when you look at what corporations are saying is that this bifurcation really exists. It's not just also bifurcation in the upper and the lower end. It's also the bifurcation throughout the globe. We have seen constantly that the U.S. consumer is the most resilient consumer out there. Where is the weakness coming from right now? That's coming from China.
Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Hakes. Yahara.
Hi, Lisa. Japanese Prime Minister Fumio Kishida won't run for a second term as leader of the long-ruling Liberal Democratic Party in September. He said in a news conference he will devote himself to supporting the new leader selected through the presidential election. Kishida's successor will be Japan's third prime minister since the late Shinzo Abe stepped down in September 2020. Traders are bringing forward bets on the pace of the Bank of England's interest rate cuts. That's after UK inflation increased less than economists and the BOE expected, with CPI rising 2.2% in July rather than the 2.3%. Services inflation posted its lowest reading in more than 2 years. The BOE cut rates on August 1st for the first time since the pandemic. The bank meets again on September 19th. And shares of UBS are on the rise. The Swiss bank smashed profit expectations in the second quarter with strong client inflows and investment banking revenue, helping CEO Sergio Eremati's efforts to return capital to shareholders. The bank says it's on track for pre-merger levels of profitability just a year after completing the takeover of Credit Suisse.
proud that we made very good progress in the integration, and so we significantly now reduced the risk of the integration itself. And we did that while staying close to clients, deliver very good financial results, which makes me comfortable that we are on a good way to deliver on our 2026 financial targets.
But despite Aramati's optimism, UBS says it also expects to book another $1.1 billion in integration-related expenses in the third quarter. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, keeping big tech in check.
Our free enterprise system is one where the best ideas are supposed to win. And we've historically seen that it's the disruptors and entrepreneurs that have been a key vector of innovation.
That's coming up next. This is Bloomberg. Just coming off the biggest four-day rally in the stock market going back to last November. Welcome back. This is Bloomberg Surveillance. Right now, we are completely flat, 54.59, heading into CPI coming up in less than 3 hours' time. Meanwhile, we do see that ongoing dollar weakness as people take a look at just how much the Fed could cut. Under surveillance this morning, keeping big tech in check.
What I oftentimes hear from the business community, they want markets to be more open and more fair and more competitive rather than incumbents being able to squash out nascent competitive threats. I mean, our free enterprise system is one where the best ideas are supposed to win. And we've historically seen that it's the disruptors and entrepreneurs that have been a key vector of innovation.
Here's the latest. Bloomberg News reporting that the Justice Department is considering a bid to break up Alphabet's Google. This following a landmark court ruling that found the company illegally monopolized the online search market. Any move would be Washington's first push to dismantle a company on those grounds since efforts to break up Microsoft 2 decades ago. Joining us now is Bloomberg's Mike Shepard. Mike, a lot of people are calling this the most consequential case for the internet, going back to the creation of the internet. Can you just lay out the contours of what the government's argument is?
Absolutely. And I think you really touched on the theme here, and that is just the scale and the consequence of this. It would be, as we noted, the first attempt by the government to break up a big company since it went after unsuccessfully Microsoft more than 2 decades ago. Here's what they're going after. They are weighing whether to force Google to divest its Android operating system, its Chrome browser, or its AdWords platform for search text ads. It's not just online search that was found to be a monopoly by Google, but also the search text ad market. And the judge in the case is asking the government to come up with potential remedies that it can present, even as Google is challenging the initial order that the judge issued just a week ago. This scoop from Leah Nyland and Anna Edgerton, our colleagues here on the legal and tech teams, really advances the ball in our knowledge of how serious the government is in pursuing this case. And what we're finding from our reporting is just how serious the government is taking this and the kind of signal it is trying to send to other companies that are pursuing on competition grounds.
Shep, over the weekend, J.D. Vance said on Face the Nation that it was the Donald J. Trump presidency that started this antitrust lawsuit. So in a lot of ways, he says him and Trump look at things in a lot of the same ways. They want good work wages for the American people, but also they want to be able to speak their own mind. And sometimes that means you got to take on those monopolies. Whether or not it's Harris or Trump, is this the direction of travel from here on out in Washington, D.C.?
This is really written in the stars now, that it is a bipartisan view that big industry, and especially big tech, has acquired too much clout, not only for its own good, but for, as we just saw FTC chair lay out, the good of innovators and the small tech in Silicon Valley that J.D. Vance knows well as a former venture capitalist. They see the large tech companies, the incumbents, crowding out the smaller players who could bring something in. And they're seeing companies like Google and Apple, which is facing an antitrust case of its own brought under the Biden administration in March, that the claim is that these companies like Google, like Apple, are crowding out the innovators, and they're also causing consumers like you and me to have to pay more for our goods and services.
Well, Google is just going to say what they do is basically what cereal companies do, or any consumer brand in the grocery market, which is you pay for a better eye level when you're in the grocery store shopping. If that's the case, what does the DOJ do with Google when they take this appeal?
Well, what the DOJ is saying in response to that is that, sure, fair enough, you have a system that, sounds like it works for you, but what about the cereal maker who is perpetually at the bottom of the shelf? They are never going to make it to the top tier because they do not have that kind of exclusive contract and relationship already established. So if the government ultimately does not pursue as drastic a remedy as forcing all these divestitures, it will at the very least go after some of these exclusive contracts that require, for example, if you're a device maker and you want to use the Android operating system on your handset or whatever it may be, you have to also make sure that under the current contracts that Gmail and the Chrome browser are on there and they're bolted on there and they're really hard to remove. You basically can't do that. And what that means is that if you're a competitor and have a different browser, a different email platform, you're already at a disadvantage. In other words, to use your cereal analogy, pushed lower on the shelves. And what the government is saying is that there should be more access and more mobility and less restrictive clauses and contingencies and contracts that crowd out through these means other competitors that might want to get in and ones that might offer a better deal to consumers.
But Mike, unlike cereal, which is, if we can stretch this analogy, which is easier to choose and easier to put on a new brand into your bowl, Google is sticky. People have this whole infrastructure around their emails, around the search that they like. So even if we get rid of these agreements that Google has to pay for access to these various phone platforms, how much of a difference will it actually make?
Well, it's a great point, Danny, because the whole issue and argument made by both Apple and Google is, hey, look, our system works really well and it works well for consumers. There's a lot of ease in it. Once you're in, for example, with Apple, once you're in the Apple ecosystem, you really kind of find it easier to use in a way as a consumer. But the price of entry is high. And that is one of the things in the Apple case the government has gone after. So what the government is seeking is also some interoperability. What they want is so that you have the functionality and everything else you might like about Google, but they want more entrance into the field and into the platform that Google has created and other brands have created as well.
Mike, just real quick here. I'm looking at shares. They're down about 1.1% in the pre-market trading, but they are up about 18% year to date. I'm talking about Google or Alphabet, the parent company. How seriously are people taking this case in terms of its ability to actually win and affect real change?
I think they're in wait and see mode. And this is a good question, Lisa, because ultimately, what will be the impact on the business? When you talk about AdWords, the company's search ad business in the most recent quarter generated $46 billion in sales, and that's out of $67 billion in total sales for Alphabet Inc. And so we're talking about a big chunk of change. Now, moving the platform or forcing them to sell it or make some changes will not drastically reduce that revenue. They are still going to be able to sell those ads. It's more how they do it and what gets attached to it. There is also a wait and see aspect because of the appeals. Google is going to fight this in court, and investors are waiting to see whether ultimately there is some sort of settlement here.
Bloomberg's Mike Shepard, thank you so much for being with us. It was really interesting, and I just imagine the cadre of Google lawyers versus Lina Khan in a courtroom.
Well, Google continues to say that they have competition. It's one click away. Like, to use the grocery store analogy, which they use, one eye movement up away is cereal. One click away, you can go to Bing, is their whole defense.
Click is important. Our fingers are, limited in their resources.
It's easy.
Is it though? Anyway, coming up, a surging stock market driving returns for Norway's sovereign wealth fund in the first half. Don't miss this. CEO Nicolai Tangen joins us next. This is Bloomberg. What sell-off? It hasn't really happened considering the fact that we just had the biggest four-day pop in the S&P 500 going back to November. Right now, basically, markets are unchanged. Hard to know how to read things ahead of the CPI print coming in about 2 hours' time. NASDAQ futures also pretty much flat, but the NASDAQ, Danny, has been leading throughout this. Russell 2000 right now outperforming, but has been underperforming as people go back to the ones they know best.
I think it'll be interesting to see how the market reacts to if we get a soft CPI report, because last month we did, it was actually S&P 500 that fell and small caps took off like a rocket. We saw that trend continue for some time. It's an odd playbook that usually doesn't happen if there's a softer CPI. It usually powers the whole market. So is this time going to be the same or different?
Well, this playbook seems to be very simple. The Fed's going to cut rates by 100 basis points and everybody wins, because that is essentially what's being priced into the markets. You've seen almost a 40 basis point decline in two-year yields going back to about July 29th. Right now, we're seeing just an ongoing of that trend, 392.67. I remember that time when it was above 4%. T-bills, what does that mean for them? 10-year yields have not declined nearly as much, 3.83%. The 30-year also 4.1%. But really, this all comes down to, does the Fed have enough ammunition to really, Danny, cut rates proactively before we see that pain?
The language suggests that they don't feel that they are there yet. And I go back to Bostic's comments yesterday. Everything he said, we want to be absolutely sure. I'm willing to wait, but it's coming. I want to see a little bit more data. All of that suggests that they are not there yet. So this CPI could be crucial in importance to changing them. Again, I go back to the RBNZ, who cut rates today and said, we can do it because it is low risk and it is not a difficult decision. Maybe the Fed starts to sound more like that in Jackson Hole.
And if you're looking for members of the Fed who want to lean into the labor market, especially we've been looking at all of this labor data coming out, the prior report that was soft, Thomas Barkin said, there's no hiring, there's no firing. It's basically flat. So then that reiterates this idea that they need more prints. And Stuart Kaiser, who's going to be joining us, said it's not that they need better inflation prints, particularly better. He says what they need is more. They've been talking about how they need to see this trend. Will we get that today?
All I can say is Danny's making New Zealand great again. Meanwhile, if you bleed this through the currency market, you do see the euro pretty much at the highest level, the strongest level versus the dollar, going back to the very beginning of this year. Under surveillance this morning, U.S. CPI data due in about 2 hours at 8:30 a.m. Eastern. The median estimate in Bloomberg survey seeing a modest gain of 0.2% on headline inflation last month, likely cementing expectations for a Fed rate cut in September. Danny, I think one of the most interesting aspects is just how coiled markets are going into that for a soft print.
It's important to think of what happened since last month's CPI print. It was the peak in dollar yen, and we saw the madness after that. You saw two-year yields. You've been talking about this go from 4.5% to under 4%. We had this mad rally and give back in small caps and equities as a whole. So it's been a real big trend shift in this market. And today, I think, serves as a referendum on that. Will it continue, or is it just more volatile and chop as we try to figure out where we're going from here?
Meanwhile, in the wheel of different stories that just keep spinning around, we also have wondered where the political influence has been, and people have tried to kind of push it aside, but it's very much there. Kamala Harris rolling out details of her economic plan in North Carolina on Friday. A campaign announcement said Harris will speak in the swing state on her plan to, quote, lower costs for middle-class families and take on corporate price gouging. It is a rather difficult needle for her to thread, Anne-Marie, considering the fact that she wants to distinguish herself from President Biden while also basically supporting the plans that he put out there.
She's going to be touting what they would call some of the wins from the Biden administration, the Biden-Harris administration. But at the same time, if you look at the polling, inflation remains top of mind. And if you ask voters, who do you think does better with the economy, especially when it comes to inflation, because we had that FT poll, which they say they trust Kamala Harris with the economy more than former President Trump. When you look under the hood, when you look at inflation, it does seem that voters think that Trump did a better job. So it's going to be a hard needle for her to thread, because she needs to, at the same time, talk about maybe some of the wins and a continuation of Biden. She has to put some distance there.
I also am very much looking forward to talking about policy once again, rather than simply the tit for tat. So my personal opinion,
finally get some.
There you go. I am very much looking forward to that. Meanwhile, earnings keep coming in, both from corporate America, corporates globally, as well as investment firms. Norway's $1.7 trillion sovereign wealth fund returning 8.6% in the first half, with a surging stock market driving the gains. The fund revealing that it trimmed holdings in Meta, Novo Nordisk, and ASML Apple, Microsoft, and Nvidia were its three biggest investments at the end of June. Nicolai Tangen, star of the podcast world, also who happens to be the CEO of the biggest sovereign wealth fund in the world, Norway's sovereign wealth fund, joining us now. Nicolai, great to see you. Thank you for being with us. I want to start with the idea of lightening up a little bit of some of the tech holdings and whether this is basically your view on the idea that leadership in the equity market might normalize a little bit more away from just the big tech leaders to the broader market in general.
Well, it's difficult to say. As you know, we are an index near fund, and so the large tech companies will automatically be some of the largest positions we have. I think it's interesting now that the seven biggest companies we have combined is like 12% of the fund. So it's a type of concentration risk that we have never seen before. And of course, that's a bit worrisome.
Nicolai, I just wonder how you think about this moment more broadly. We're waiting for CPI in the US, but in the rest of the developed world, rates have started to come back in. The conversation has changed to fear of recession. For you, is this the start of a paradigm shift for this economy and these markets?
I'm not so sure that that's the case. We think that inflation generally will be pretty slow to come down. We're seeing some inflationary pressures, actually from the climate. We're seeing some food elements within the CPI, such as olive oil, orange juice, all these kind of things. These prices are continuing to rise, and we think that will be part of the effects which keep inflation higher for a bit longer.
Well, as inflation is higher, to your point, Nicolai, the big tech just keeps getting more and more concentrated. I know you've trimmed back on some of your holdings, but do you worry about the unhealthiness of an overall market that keeps contending with central banks doing the same thing, about not a shift? Is it a market that you worry has gotten over-leveraged and you could see more events like a volatility akin to last week?
Well, I think if you talk about leverage, I think the thing that worry us here is the debt levels we are seeing in many countries. The budget deficits, which continue to be there, continue to build. The debt levels are very high. And I think that's really the biggest worry we have. You see what can happen if you get these kind of trust moments, which we saw in the UK, where suddenly people lose faith. And that's probably the biggest risk we are facing today.
What I find fascinating, Nicolai, is when we talk to you, you really emphasize the fact that you're hinged to the index. You own the world, essentially, and you are sort of susceptible to the different trends that come into play. One thing that you've been very vocal about is that you're trying to use your position as the biggest sovereign wealth fund in the world to influence change. And I'm wondering, with respect to concentration, as an example, we're seeing the Department of Justice in the U.S. go after some of the big tech funds to try to increase competition. Do you think that's a good thing? Are you arguing within board seats saying, you should make efforts to try to open up the competitive field?
Well, we as big owners, we are not advocating to split up large tech companies. Of course, we think that things like AI should be regulated, and we really need to have responsible use of AI, but we are not really interfering in the debate about whether these tech companies whether one should go after them or not. I think they generally do. They are fantastic companies. They are well run, and they are important investments for us.
It kind of goes to the heart of this issue that comes up so much, Nicolai, which is how do you balance having a sort of social overview for your fund where you're trying to invest in renewable energies, you're trying to argue for changes at the tops of companies, while maximizing returns that might not cohere with some of those trends so perfectly? I'm thinking of, say, fossil fuels or the renewable energy infrastructure that didn't perform as you had hoped.
Well, a couple of things there. First of all, we think you have more influence as an owner as you have compared to if you just sell out your holdings, right? We have continuous dialogues with these companies. During the first half, we had more than 2,000 conversations with our companies. And so being an owner is the best thing you can do in terms of impacting change. The second thing is that we think being a responsible company and delivering good returns is going hand in hand. If you're not a responsible company, you will not have people working for you, you will not have clients, you won't get insurance, you won't get bank loans. So it really goes hand in hand, and you need to think long-term as a responsible company to generate the returns.
Nicolai, how are you thinking about the U.S. election and the impact either Trump 2.0 or Harris administration will have on investors?
Yeah. You know what? You'd be surprised by how little we think about the U.S. election, because we are invested in the U.S. companies, and both parties are, in our mind, pro-business And so we don't think that's going to have a huge impact on our portfolio.
You think both Trump 2.0 and Kamala Harris are pro-business? You think both Democrats and Republicans are pro-business?
We think generally speaking that the large U.S. companies which we are invested in will continue to do well, whoever wins the election.
We know you're a big holder of Tesla and you voted against Elon Musk's pay package. What do you make of corporate America, some CEOs like Elon Musk, really tying themselves to one camp? Clearly, he's in the Trump camp with his most recent conversation with the former president this week.
Well, I think it's interesting, and I think it's a new phenomena, and of course, it is risky for companies to tie themselves too closely to one camp.
Nicolai, can you just expand on that a little bit? Because obviously when you look at companies, there are different metrics you have to look at. And some of the metrics include governance. Does that kind of fall into the governance camp? Do you need to take a second look at companies that are maybe getting too political?
No, I don't think we need to do that. We would not want to sell out of a company if it's close to one political party or the other one. So I don't think that's necessarily relevant for that decision. But of course, you have to think about risk to people's businesses if their client base is associated them with one party or the other.
Nicolai, you talked earlier not just about some of the governance of corporations, but also the fact that we have this deficit that is surging and that concerns you dramatically, that is actually your top concern going forward. And I think about your very philosophical podcasts where you start to really do some soul searching with other big investors and chess stars of the world. And I wonder how much you're sort of forced to do that yourself when you look at a picture that looks like it's just a train wreck, but there's very little that an investor can do about it.
Yeah, it is very little because this has been a development which has been going on for a very long time. Investors have been warning about it for a long time, and when these kind of things, like big budget deficits, it's okay until it isn't, and you don't know what's going to be the trigger. But if you have like a trust moment, which refers to the situation we had in the UK, then when it comes, it's going to be it could be pretty dramatic, and it happens very quickly.
But for yourself, how do you hedge against that? Do you become a bond vigilante or do you not have that luxury?
No, you can't. I don't think as a long-term investor you can hedge against that kind of thing. I think that would be speculation, and you would need to make a judgment on when exactly that happens. And I don't think we don't have that insights or any view on exactly when it could happen.
Nicolai Tangen of the Norway Sovereign Wealth Fund, thank you so much for taking the time. Look forward to your next episode of the podcast. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. Intel has sold its stake in chip designer ARM. That's according to regulatory filings. The sale is expected to raise about $147 million for Intel, which is already facing losses and job cuts. Earlier this month, the company filed one of its worst earnings report in its 56-year history, causing the stock to lose a third of its value. The chip maker has already announced it's slashing 15,000 jobs and has suspended its dividend. Paramount began laying off staff yesterday after announcing it will cut 15% of its U.S. workforce. As part of the move, the media company is closing its production arm Paramount Television Studios. All current shows and development projects will transition to the existing CBS Studios production arm. According to an internal memo seen by Bloomberg, job cuts will take place in 3 phases this year, with 90% of cuts coming by the end of September. And New Zealand's central bank cut interest rates, embarking on an easing cycle far sooner than previously indicated. The Reserve Bank lowered rates by 25 basis points, having said in May that it considered raising rates and wouldn't cut until the second half of 2025. The bank's concerns over sticky inflation are being alleviated as the economy hovers on the brink of a third recession in less than 2 years and unemployment continues to rise. That's your Bloomberg Brief. Lisa?
Yahira, thank you so much. Look, I love New Zealand. I think it's great. I think it's an aspiration of mine to spend some time there. Danny, are we making too much about New Zealand?
Okay, maybe. But I will just caveat that with saying it's an interesting decision that they cut, and they said because it was low risk. I mean, there are so many people who would argue that the Fed should be doing exactly the same.
New Zealand, the new trendsetter. Up next, credit spreads pointing to a soft landing.
We're absolutely in the bad news is bad news type of market now. So maybe a year or so ago, if you got bad news, you can think, okay, maybe that means less inflation. But now it really does mean potentially fundamental problems.
That's coming up next. This is Bloomberg. Right now, markets are prepared for another Goldilocks kind of day, basically range-bound on the S&P. That can change. It changed yesterday heading into the close. What you're seeing right now is a dollar weaker, and this really is the key story. The Fed appears to have the ability to cut rates. That is what the market is saying, and that is what yesterday's PPI data seemed to hint at. Euro at the strongest level, crossing through that 110 level. Strongest level going back to the beginning of this year. Under surveillance this morning, credit spreads pointing to that soft landing.
We're absolutely in the bad news is bad news type of market now. So maybe a year or so ago, if you got bad news, you can think, okay, maybe that means less inflation. But now it really does mean potentially fundamental problems. But we're not really seeing that. So we actually still think spreads where they are. Yes, they're not compensating you for a recession, but we don't think there's a recession that's going to come. Here's the latest. Markets seeing plenty of room for the Fed to cut amid easing inflation concerns. But Justin Dercole, a longtime head of Barclays fixed income syndicate business, is pushing back, writing, quote, there's an expectation that these higher rates are very restrictive, and we're waiting for the consumer shoe to drop and wipe out the labor market. If that were going to happen, it would have happened already. Justin, who currently is the head of ISO-mts Capital Management, joins us now. Justin Dercole, I want to start with that. Why are you pushing back so aggressively on this?
Yeah, so the beauty of focusing on banks, which is what we do, is we have a particularly strong lens into the economy. And so what we're seeing is that asset quality is actually trending better. And that ultimately, if you were going to get the long and variable lags that get so much attention in the press, they would have happened already. It would be transmitted through the credit channel, Lisa, and that just hasn't happened. So if I am a bank, most of the large banks, all of the large banks really are well capitalized. Their profitability is better than it's been since the global financial crisis, and their asset quality trends are moderating. And so you put all those things together and the banks are going to lend. And so if they're willing to lend, ultimately a consumer that is now getting used to these higher interest rates, you put all that together and overlay a capital market environment that's been very favorable. Credit spreads have been near their tightest levels of the last 20 years, going back a couple of weeks. We've had a little bit of a blip in the last week and a half, 2 weeks. But I put all of that together, and then I'll either turn on the TV, listen to the radio, read the press, listen to pundits, and I really have no idea where people are getting this risk to the economy.
Well, hold on a second, Justin, because I'm sure that you hear a lot of those people here on Bloomberg Surveillance. They come on, the Neil Duddas of the world. We'd love to get you guys in the same room, coming on and basically saying, what is the rush? This is the time. What is the is the holdup? This is the time. What are they waiting for? Let's go. Justin, how do you sort of dismiss some of the concerns that we're seeing from a lot of corporate executives that are coming out and saying the consumer is feeling weak? What do you say about Home Depot saying that they're waiting for rates to be lower to actually make those purchases?
Right. So I think that's an important point. So the consumer has been waiting. And I think so if you look at loan growth, it's been very tepid. It's finally started to pick up. If you look at the Fed's H8 report that came out last week, loans are finally picking up. So what I would say is there are two dynamics here. One dynamic is companies and CEOs, if they're having issues, it's very easy for them to point to a consumer that is challenged. And I don't want to say place blame, but effectively use this crutch to help them talk about their challenges. The reality is that, and this last payroll report probably stands out to me the most as being so completely different than what the narrative was. 200,000 workers were impacted by weather. And I don't know how the BLS said that weather wasn't a consideration. I don't get that. It didn't make any sense to me. And so there's almost certainly going to be a get back in the next payroll report based on the weather effects. So here's what I would actually ask the CEOs who are talking about a challenged consumer. The second quarter grew at 2.8%. and retail sales were very strong in June. We're getting retail sales tomorrow. The strength at the end of the second quarter means that the third quarter is almost certain to get off to a strong start. Goldman has a Q3 GDP tracker that they're already out with, and I think it's in the mid twos. Atlanta Fed GDP now is in the high twos. So when is the future the present? That's what I want to know, and I really just don't get.
Justin, what we've heard from CEOs, though, if I could just interrupt you for a second, is there are two different types of consumers. What does the Fed need to do for those that are struggling on the lower end, that aren't impacted by the stock market and all-time highs we've seen, because they're not exposed to money markets and stock markets?
Yeah, so there's another issue there that is disconnected from reality. So there is a report from Barclays that came out after Q1. So it's a little bit dated, but I mean, relatively recent. And if you actually look at the underlying spending trends, the lower end consumer actually was doing better in the first quarter from a consumption standpoint than higher end consumers. So again, what I would say is, I'm not sure that what you're hearing is reality. And let me try and put a fine point on that. Okay. If I'm a lower end consumer, wages are growing right now at a much higher rate than they did pre-COVID, certainly, and immediately post-COVID. Okay. So you have better wages. You have a growth in a rise in the unemployment rate. That is because new entrants are coming in. Now, let me ask, so some of it's immigration, but why are new entrants coming in?
Justin, can I ask another flavor of this? Because you're talking about the strength in the consumer, that the long and variable lags haven't arrived. What do you make of just inflation then coming back down to the Fed's target?
Right. And so therein is the interesting dynamic. If the neutral rate is higher, which I would say, and this is the point I actually think is most important, the neutral rate is higher. At some point, you have to reconcile that. Otherwise, the market is taking down duration, financing this deficit at the wrong levels, at too low a yield in aggregate. And that's a concern. So what I would say about the inflation is that there is an expectation every time inflation gets down here that it's just going to keep going straight down. I don't think that's realistic. And most people agree with that. And yet the market doesn't want to trade it that way. It just wants to assume that it's going straight back to 2%. Last point, let me just make. In 94 and 95, there was this mid-cycle adjustment people talk about. That was after a negative payroll print the Fed cut in 95. So we're nowhere close to that. You're running payrolls after we get this give back. You're probably running payrolls close to 200,000 a month.
Yeah.
It's totally like the narrative and reality are disconnected. It's finally going to come home because at some point the market will have to say, how are we living with a 5% policy rate now for 12 months?
Yeah.
So we have ex post data that supports this idea that the neutral rate is higher.
Justin Dercola of ISO-mts Capital Management, thank you so much. A lot to go through. We didn't even get to what you're doing with all of that, but we'll have to leave that for another conversation. Coming up next, Stuart Kaiser of Citi, Bloomberg's Mario Parker, Marriott Chief Executive Officer Tony Capuano, and former Chicago Fed President Charles Evans. I want to issue up a correction. I was kind of ragging on New Zealand, and I got this message that New Zealand is where the 2% inflation target came from. So maybe they're punching above their weight.
Oh, I feel a little bit vindicated. Thank you to that viewer.
Yeah, so New Zealand is still going to be very much present in our show. This is Bloomberg.
We are being whipped around on every single cyclical data release.
I also think we're putting a lot of weight on one data point.
I would sit there and say the most important numbers are going to be the jobs report initial jobless claims, and the CPI report.
I think the market gets spooked about the uncertainties of global growth.
I wouldn't be surprised if the volatility continues for a while.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
90 minutes until the moment of truth. We are talking about CPI. Welcome back. This is Bloomberg Surveillance from our New York City studios. We have Anne-Marie Hordern. We've got Danny Berger. I'm Lisa Abramowitz. Jonathan Ferro is still off on his week-long jaunt, well-deserved vacation. Right now, we are looking ahead to what CPI will really show in about 90 minutes' time. Danny, the key question in my mind is, how is this market positioned and how leveraged is it still to that Goldilocks story?
That's such a powerful rally yesterday. On what? On PPI, something that usually doesn't move the market. Yet here we are, equities basically doing a round trip where they are at the start of August before we had that major sell-off. So it is a market that really feels ready for a softer CPI. It thinks the trend will continue from last month that saw this violent rotation. So there's a lot at stake today.
Which is the reason why people are trying to understand what the dynamic is between sort of the soft landing and disinflation versus a consumer that seems to be pushing back. It really ignites people's emotions. I mean, we saw that just with Justin Dare Cole saying, what are you guys talking about? This is not a Fed that needs to cut rates. Then you have Neil Dutta saying, what are you waiting for? Cut rates. I mean, the real emotion here, and frankly, data to really back up either viewpoint.
Data and also the commentary, what we just heard from our previous guest, that's coming out of corporate America. But really, the distinction is the bifurcation. CEO after CEO is talking about this softening, especially on the lower end consumer. The higher end continues to spend. They're going to the Four Seasons, which we had the CEO on yesterday. It's the lower end consumers that are, to Home Depot's words, are deferring these big purchases. They're waiting to see what the Fed is going to do before they go out and spend more money.
Yeah, we talk about Four Seasons. Where are they expanding in private jet business, not necessarily in terms of going into other particular aspects of the population. So the key issue here is not exactly what the data is, but how the Fed will respond at a time where we have seen inflation come in. Yesterday's PPI print was softer, healthcare costs in particular, leading that downward. CPI is expected to come in 0.2% month over month. Versus the prior actually decline. Key question in my mind, Danny, given the fact that we've seen that huge rally in two-year yields, we see the euro at its strongest level versus the dollar going back to the very beginning of this year. How leveraged is this market to a perfect outcome that really underscores that the Fed could cut rates by 100 basis points this year?
I was going to say, all you need to do is look at what we're pricing for September. 50% odds that they go from 50 basis points. And the debate at the Fed is just, has inflation even come down a lot? Enough for them to be able to deliver 25 basis points. So the reaction of the market, of course, will be interesting today. But the reaction of the Fed, I think, will be even more telling. If they get a softer print, do they simply just say, OK, well, cut 25 basis points? Even if that's the case, the market is still off sides.
Well, and Raphael Bostic trying to push back in the same kind of camp that we've heard from others. Right now in markets, kind of doing nothing ahead of that print. You don't blame people considering the fact that everything can change in about 90 minutes time. We also are coming off, as Danny was mentioning, the biggest four-day rally going back to November of last year. The euro, to me, really interesting, going north of 110 for the first time in months. And we're really seeing the highest levels that we've seen since the very beginning of January. Yields continuing to decline across the board, still disproportionately on the front end. 10-year yields 3.827, and crude coming off just a touch after a big rally last week, but seems to be tempering as people start worrying more about the growth aspects, down about a third of 1%. Coming up this hour, Stuart Kaiser of Citi following the S&P 500 biggest four-day rally this year. Marriott International CEO Tony Capuano on that bifurcated outlook for travel demand that Anne-Marie was talking about. And former Chicago Fed President Charlie Evans ahead of U.S. CPI. Let's begin with the big story. Stocks on hold. Traders are awaiting that CPI data at 8:30 a.m. Eastern. Stuart Kaiser of Citi writing this. Sentiment is edgy as growth slows. CPI may be a modest positive, but carries less weight this month. We are still cautious, but IGV calls screen well for a bounce. Okay, this is counter consensus, Stuart. Everyone is saying that this is the biggest CPI print since sliced bread. Why do you think it's not?
Look, I think the market's kind of shifted its focus a little bit to the growth side of the ledger. I think both the Fed and the market are, at this point, pretty comfortable. Inflation's on a bit of a downward trend. So the inflation print matters, don't get me wrong. But I think if you had a high print, the market might just say, well, we're trending downward. This is normal data volatility. To me, like 0.1 to 0.2% is your sweet spot. I think if you kind of print in that area, that's going to be positive for equities. They'll respond well. The lower print, I think, is where there's more uncertainty. uncertainty in terms of how the market would react to that.
Hold on a second. This is actually really interesting. A lot of people who come on say that the real issue and the reason why they care so much is the Fed can cut rates as long as inflation is coming down, as long as there isn't that inflation concern. You're saying that the bigger concern is that people aren't considering the downside risks to the economy. In other words, an upside print, an upside surprise in inflation, you don't think would actually disrupt this market that much?
I think it would disrupt it a bit, but not the same way it would have, a few months back. Because, the Fed has basically said, we don't need lower inflation data, we just need more of the same, right? So I think that means if you're printing 0.2s, the Fed wants to cut regardless. So I think in that context, an upside surprise doesn't really change the calculus as much as it would a couple of months ago. If you print very low, then the debate becomes, first off, the market will react to that positively initially because low inflation means the Fed, the cuts are kind of baked in at that point. But I think ultimately people might take a step back and say, geez, we just printed, let's say, sub 10 basis points core CPI 2 months in a row. What is that telling us about the underlying demand strength of the economy in that case? So that's why I don't know how the market will react to that really low print, but it'd be very interesting, I think, to see that in real time.
Well, it was that print last month that was kind of the starting gun for this volatility, this trend shift, this change that we saw in markets. And one of them was this false dawn of small caps outperforming. You get this really powerful rally that peters out as the rest of the market starts to freak out. If we get a low print, I know it's hard to judge what the market will do. Could it give another leg to that small cap rotation?
It could. At the time, we had said there's a window here for small cap to work. The problem is it's hard for small cap to work unless you have soft landing data, right? So I think what you had is you had small cap responded initially, then you had kind of some choppy tech earnings, which brought the market at large down. And then you had that softer payrolls print. So if you think of why did small cap respond so positively in July is because you printed 200K and you backed that up with 6 basis points on core CPI. This time you're printing 114K and we'll see what happens on inflation. So I think a lower inflation print can work, but you really need, in our view, soft landing data for that to happen. And we just haven't gotten that out of the labor market the last 2 weeks.
Well, so, if CPI can't really tell us that soft landing data, is the market more coiled up then for retail sales? Is that going to be the more important print this week?
I think you could argue Thursday is more important than Wednesday this week. It's not just retail sales. You're also going to get another claims number, and you also have Walmart printing that morning as well, to Emery's point on low-income consumers. So I think the collection of data Thursday might be more important than CPI on a standalone basis. Retail sales is a little tricky. The markets don't tend to trade retail sales that much. But look, everything is context dependent. And in the context of the markets right now, that retail sales claims at Walmart might be actually more important than CPI.
We've seen some outsized movements to data that normally we would just ignore. Do you think the correction is over?
I hope it's over. I would say, we're watching the VVIX, which is basically implied volatility on VIX options. That still remains quite high. And the reason our focus is on that is because the VIX was kind of center of gravity for this sell-off. And we haven't seen that risk pricing completely normalize itself. And until we see that, you have to be a little bit concerned that there's still some positioning issues in the market.
But how are we supposed to see normal volatility when it's, it's August, so there's not a ton of liquidity. We have a very important Fed decision in September and then a U.S. election in November. When will volatility start to calm down?
Well, hopefully this week because it's the end of summer. Look, I think right now you're in kind of a weird spot. You have Jackson Hole, you have DNC coming up. You have a payrolls print that the market's still digesting, and you obviously have some positioning stuff going on that's sort of put risk takers on their back foot a little bit. So that is going to keep volatility elevated a bit. What gets it down? A, vacations, that might help, and B, frankly, I think it'll have to be you're going to need claims data to continue to remain solid. You need payrolls to kind of come in a bit. So it's going to be data dependent, I think.
It sounds like you haven't taken your vacation yet. Is that pretty much correct?
I have not. If I'd known John was leaving, I would have tagged along with him. No,
shots fired.
Where is he, like in Sardinia or something? He's got to be somewhere famous.
All I could say is I tried taking a vacation last week. It didn't work. I am wondering where the most susceptible aspects of the market are to a potential sell-off. We saw, for example, tech stocks reprise their haven aspect over the past week or so. And yet your own Chris Montague came out and said actually he sees tech stocks as being highly susceptible to a pretty big sell-off with any downside economic surprises. Is this kind of the area that you see? Is it sell what you can, or are these areas more susceptible to downside in the economy than people give it credit for?
Yeah, I think I'd sort of break that into two categories. If you're worried about just like kind of hard landing data, I still think you want to focus on that domestically facing cyclical aspect of the market, which is going to be small cap and retailing. Tech to me is a very interesting discussion right now because let's say you got hard landing data typically you'd want to be in larger cap, safer balance sheet, dividend paying type stocks. That sounds an awful lot like large cap tech. But to Chris's point, the positioning is really, really long in tech. So I think that's the kind of riddle you're trying to solve is in a weaker growth environment, do people go and hide in those stocks? Or in a weaker growth environment, do they have to sell and that's what they own? So they kind of sell what they own and you get kind of a positioning unwind. So ultimately, we're just going to have to kind of see how that plays out. I agree with Chris. I think both the yen carry trade, which has been talked about quite a bit from a positioning perspective, and tech, these are huge, long overweights that have been built up over a multi-year period. You're not cleaning out that positioning in a week. I don't care who's estimating. It's just not happening. So I think that's the risk to tech is that you get a large enough sell-off that people need to degross positions, and tech is what they own, so that's what they sell.
This is an interesting point, especially because we have seen, as Danny was pointing out, in the yen trade, we have seen ongoing strength there. So it's not exactly like that's come off the boil in terms of that particular carry trade. With big tech, are we back to where we began before some of the turbulence last week?
I don't think 100%. I think sentiment did get a little bit dented around large cap tech earnings. Just this idea that if you do you had core businesses, at Amazon in particular, at Microsoft as well, like their core businesses weakened a bit. And then you had Google talking about potentially a little bit less CapEx. And the problem with that large cap tech universe is it's just a feedback loop, right? I mean, if you're spending on CapEx, you're buying stuff from NVIDIA, and NVIDIA sells you the chip, and it goes in a circle. So I think that kind of I do think there was a little bit of a shot across the bow there on A, the positioning, and B, sort of the interdependency of these stocks. So I don't think it's 100%, cleaned itself up yet. I do think there's a little bit of, kind of worries about positioning and sentiment in that space. If you look at something like NVIDIA, I do think there is a floor on a stock like that. Talking to institutional investors somewhere in that $90 to $100 range, I think people want to be involved in that stock. But, getting down there hurts. And that's why your vacation got ruined, basically.
I do just wonder when things like that are washed out, because one of the criticisms I hear is not that we got really over-levered on the yen carry trade necessarily, but just the amount of leveraged products. The fact you can go out in the market and buy a 3 times levered NVIDIA ETF is madness in this environment. So, I mean, do you need to see basically the end of those types of products? Because it feels like people are happy to buy them. They're happy to do 0-day to expiry options. Nothing has discouraged people from buying these types of products. So do you just foresee a washout of that to get back to normal?
I mean, it's a good question. I mean, last Monday, 0-day options were 26% of total options volumes. That's half their normal. So you definitely saw, at least tactically, that trade, kind of get put on hold. The lever products, they're not going away. I mean, they've been introduced. People understand them. People want to use them. And, the leverage issue is interesting because there's certain investors, like a vol target fund, for instance, they add leverage not because they want to. They have a formula they follow, and when realized vol is low, they kind of continue to buy. So look, these products aren't going away. The street's aware of them. I mean, we know when the overrating ETFs have to rebalance. You know what's getting traded in 0-day space. So they're not going away, full stop. The question, I think, is more what you might call discretionary leverage. That might be a retail investor using margin. It might be a hedge fund kind of levering themselves up. That kind of leverage can kind of get pulled out of the system a bit. But these produc's, I mean, they're here to stay. They're not going anywhere anytime soon.
Stuart Kaiser of Citigroup, thank you so much for being with us. Really appreciate it. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief with Yahira Hackes. Yahira.
Hi, Lisa. Shares of Kellanova are rising in the pre-market, up nearly 8%. Mars agreeing to buy the snack maker for $83.50 per share for a total consideration of nearly $36 billion. Kellanova makes products like Pop-Tarts, Pringles, and Cheez-Its. It was spun off from Kellogg last year. Since 2020, Mars, which is known for M&Ms and Skittles, has also scooped up snack bar maker Kind's North America business and Nature's Bakery as it expands its snacks portfolio. Shares of Alphabet are lower in the pre-market. Bloomberg is reporting the Justice Department is considering forcing Alphabet's Google to break up after a landmark court ruling found the company monopolized the online search market. The move would be Washington's first push to dismantle a company for illegal monopolization since unsuccessful efforts to break up Microsoft 2 decades ago. According to people familiar with the matter, less severe options include forcing Google to share more data with competitors and measures to prevent it from gaining an unfair advantage in AI products. And the UK's Wizz Air is offering a deal for last-minute travelers. The Telegraph is reporting the airline is offering an all-you-can travel annual pass for $571 a year. The catch? Pass holders can only book to travel 72 hours before departure. It's also worth noting Wizz Air was the UK's most delayed airline last year. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, the Harris Policy Platform.
All we're asking for is better wages, better benefits, better lives, and dignity in the work that we do.
That's coming up next. This is Bloomberg. Coming into a day ahead of CPI, which I'm being told by the likes of Stuart, Kaiser, and many others, that might not be the most important event of the week. It might be tomorrow, actually, with retail sales and jobless claims. Nonetheless, we are about an hour and 15 minutes away from that read of CPI. Right now, S&P futures completely unchanged. A fascinating, really volatile market out there. Not so much. This is a new, very much old kind of summer market. Euro, though, really interesting, climbing some of the highs that we haven't seen for months. 110.24 versus the dollar, one of the highest levels going back to the beginning of the year. 10-year yields marginally lower. Under surveillance this morning, the Harris Policy Platform.
The only thing those two guys knows about working people is how to work to take advantage of them. That's what they know about it. Every single chance they've gotten, they've waged war on workers. And their ability to collectively bargain to take that away from them. All we're asking for is better wages, better benefits, better lives, and dignity in the work that we do.
Here's the latest. Kamala Harris is set to roll out much anticipated details of her economic policy vision on Friday in North Carolina. A campaign source saying Harris plans to pitch lowering costs for middle-class families and taking on corporate price gouging. Joining us now is Bloomberg's Mario Parker in Washington. Mario, I'm just curious what details we can expect to get or not on Friday.
Yeah, well, we'll expect from our sources that she'll hone in on healthcare, housing, and food costs, how to lower those costs and those prices for middle-class Americans. Part of that platform, we should note, is the fact that the Democratic ticket that she was on with President Biden before she succeeded him, I should say, at the top of the ticket, the message on the economy was just not getting through. It just wasn't cutting through. And a lot of that had to do with what voters felt was a lack of empathy. And so what we expect to see from Harris, at least, is that she feels that consumers feel as though the economy isn't that great. The message that the Biden campaign had been preaching was that, hey, the economy is great. And it had been falling on just American voters just hadn't been hearing that message.
But Mario, how does she do that if we've only seen her at these massive rallies on teleprompter? How does she actually convey that empathy that they think Biden was lacking, given the fact that she is tied to the Biden-Harris administration?
And that's the irony, Anne-Marie. She's got a new lease on political life in some ways, even though she was on this ticket as his vice president. And this is to the frustration of the Trump campaign as well. Voters seem to be getting, at least based off of polls, giving her a fresh lifeline. They're not tying her to the economic, the economic report card, if you will, of the Biden administration. So she's got a fresh slate to reintroduce herself now. And you're seeing her take advantage of that with these rallies, and then we're seeing her take advantage of that with this rollout on Friday.
Is there concerns, given the fact that Bidenomics could mean something great if you're a Democratic voter, or very negative if you're a Republican and even some independent voters? Is there a concern within the Harris campaign that Joe Biden should not go on the trail with her?
We haven't saw that concern. I mean, that's a great point that you raised there. I will note that they will debuted on the trail tomorrow for the first time since Harris has taken the top of the ticket. They will be in Maryland tomorrow. Whether or not, to what extent Joe Biden, one of Joe Biden's his favorite phrases is, however he could help you, either campaigning with you or campaigning against you, he understands the politics of it all.
I do just wonder what you make of the sentiment of the moment, Mario. Anne-Marie was great talking about yesterday that we had small business confidence coming in at a 2-year high. And small businesses tend to skew not Democrat. This tends to be a group that is unhappy as long as a Democrat is in power. When you look at these kinds of surveys or these polls around how people feel about the economy, how much faith should the Harris camp take in them?
Well, they should take some faith, right? To your point, it's not necessarily that they need to win that block, right? They need to just lose less. So you're not going to necessarily turn around a historical trend in one election, but what you want to do is decrease your losses there or increase some of your support within that group. That's another way to look at it. And so there's some good economic news that's come out for the Harris campaign over the past week. Another is that in a Financial Times poll, for the first time, she surpassed Trump on the economy. That was one of his strongest his strongest topics on the campaign trail.
And in the meantime, it benefits Harris to have this kind of, very classic Democrat, nothing too controversial. And in the meantime, Trump is trying to pin her down on many lines. But one consistent one that they've been saying is she's not talking to the media. She needs to sit down for an interview. Do we have any movement from the Harris campaign in how they'll thread that needle? Not saying too much, but maybe getting at that criticism that, to be fair, isn't just lobbed at her from the Trump camp, but from the media as well.
Yes, and the irony, right, that Trump is pushing for more media access. But the thing is, they need content. They need her to sit down, the Trump campaign, that is, need for her to sit down. As I mentioned earlier, she's got this new lease on political life. So they need fresh fodder, and they're hoping that would be generated from some type of public media appearance. Listen, they're trying to run out the clock as much as they can, but they won't be able to outrun this topic. From what we understand from the campaign is that she will do an interview at some point within the next month or so. We're not sure what that looks like. We're not sure what setting that will be. We're not sure who that will be with, but she will have to do that within the next month or so.
In the meantime, Mario, just on the other side of the ledger, I'm wondering about Donald Trump, and we did see him have a rally after the assassination attempt on his life. I am wondering, though, why we haven't seen more. Is that something that it's expected, or do we have a sense of whether this is sort of a connected issue, kind of how he's getting his bearings, given some of the changed landscape?
Yeah, well, he'll have a rally today, actually, in North Carolina. This will be his first time in a swing state, I should note, in about 11 days or so, nearly 2 weeks. Before that, he did have that press conference at Mar-a-Lago on Friday. He had that appearance online with Elon Musk earlier this week as well. Some of it is he was fundraising in some places also, and then some of it is also just a function of just how much this race has changed over the last 3.5 or so weeks with Harris at the ticket. The Trump campaign, for all intents and purposes, appears to have been caught flat-footed. Some of the engagements that they had pre-scheduled already were in states that weren't swing states necessarily. He appeared in Montana to campaign against Democratic Senator John Tester, for example, which was again a vestige of the campaign from a month ago, where he was strong enough to essentially save everyone else around him, or at least attempt to save everyone else in the party. But now, with the polls showing that in some ways Harris has either drawn even or surpassed him, it's time for him to get back out there in the swing state and shore up his own prospects.
Bloomberg's Mario Parker, thank you so much for being with us. And I will just say, predict it right now. If you take a look at the betting markets, which we're evidently not supposed to look at, Liz Libby Cantrell said until after September, have Kamala Harris at 59% versus Donald Trump at 45%. What are you watching, though, to parse through the noise, Anne-Marie?
It's just fresh momentum that her campaign has right now. And what Mario said is this new lease on life. I would look at it as Harris basically closing the race. But it is a coin toss. It's 50-50. The Cook Political Report, that's how they view it when they recently moved Arizona to a coin toss, when before it was lean Republican as opposed to a few others. He mentioned that FT poll. You got to look under the hood. Still only 1 in 4 registered voters say economic conditions are excellent or good. That's not great.
Yeah, which is a reason why I think that one poll that came out of the FT was pretty interesting, suggesting that maybe that wasn't the case. We'll get the new kind of view on that coming up next. Marriott International President and CEO Tony Capuano with summer travel season in full swing. We were talking about that just with Stuart Kaiser. This is Bloomberg. We're just here getting travel tips for Stuart Kaiser so that he knows where to go on vacation. Welcome back. This is Bloomberg Surveillance. Pretty much nothing going on in terms of the index level ahead of the open and frankly ahead of about an hour away, that CPI print. You are seeing, however, a little bit of outperformance from the Russell 2000. Again, this sort of goes to the question of whether we can get disinflation without a growth scare. If you look at where this is going, on the bond world, you can see those lower yields sticking after a pretty rip-roaring rally last week. Two-year yields are down some 30 basis points since the end of July. Right now, continuing that trend, although barely, 392. You can see the 10-year also in a similar vein with a 30-year. 10-year at 382.95, the 10-year, the 30-year at 441.43. So basically, if you bleed this through, what we see in the currency market, it is a strong euro. It is a weak dollar. In fact, the strongest euro that we've seen going back to the beginning of January, which raises the question, how much is this entirely a dollar story hinged to the Fed? Under the surveillance this morning, Axios reporting that U.S. Secretary of State Antony Blinken has postponed his trip to the Middle East over uncertainty about the situation. Blinken had been scheduled to leave for the Middle East yesterday. And Marie, what do we know about where these negotiations are, as well as some of the conversations about how the U.S. views some of the ceasefire talks to staving off some of the expected violence from Iran?
Well, Biden was asked about this yesterday, and he linked the two together. He said, that's my expectation in terms of if a ceasefire agreement was reached, potentially would that mean that Iran would hold off on its retaliation. So you see the U.S. really flooding the Gulf with not just the weapons and security in case they do have to come to Israel's defense, but also with people. Brett McGurk is going from Cairo to Doha. Amos Hochstein is in Beirut. And then my expectation would be that Secretary Blinken would go on that trip, even if it was delayed. So you see a lot of effort being placed in the region right now
to try to prevent some kind of altercation that has a pretty high chance of some sort of accident and unwitting escalation. Meanwhile, sources telling the Bloomberg that the Justice Department is considering a rare bid to break up Google. The Android operating system and the web browser Chrome are the units that would be most likely to be impacted. This comes after a court ruling found that the company monopolized the online search market. Danny, a real question about how much this is actually being taken seriously. The market isn't reflecting a massive kind of sell-off, although the shares are down 1.4%. Still, this highlights something we've seen for a while, this desire to see a little bit more competition at the top.
Right, because I think even if Google isn't told that they need to break up, there are still really big ramifications. I think a great corollary for this is 2000. Microsoft loses an antitrust case, but doesn't have to break up. They appeal that, fine, they don't have to. But what then happens is they can't exert their dominance in the way that they once did. And it meant a lot of these young companies, like at the time Google, could really rise up and be a big threat to them. So even if Google doesn't break up, if it's kind of hemmed in its ability to really exert dominance in things like AI, for example, that does mean you could see some serious competitions in other areas of tech.
And this is not going to end. This is a bipartisan issue right now in Washington, D.C. J.D. Vance talked about over the weekend when he sat down one of the number of Sunday shows and reminded everyone that actually the antitrust case on Google started under the Trump presidency. And this is an individual who has said that actually he thinks Lina Khan is one of the individuals in the Biden administration that's doing a pretty good job. So when it comes to antitrust and trying to break up some of these big players, this is going to be an R and a D issue.
Meanwhile, Atlanta Fed President Raphael Bostic saying he's looking for, quote, a little more data before supporting a rate cut. He's added that he's encouraged by recent inflation readings. So question about the little more data in about an hour time and whether that will give him that confidence. We will also be speaking with him coming up in Jackson Hole. Our survey for that CPI print calling for another modest increase last month. The consumer really is in focus here, and it's really a host of data earnings that really are coloring the picture. The travel space, a growing list of companies are warning of a slowdown. Marriott cutting its full-year outlook, expecting weaker demand in North America and China. Marriott International President and CEO Tony Capuano joins us now. Tony, always wonderful to see you. Thank you for being in the studio. You know, I want to start. I feel like the U.S. consumer and the Chinese consumer are two completely different stories. So I want to start with the U.S. in terms of the greater weakness. Is it across the board, or is it this bifurcation that we just keep seeing? Higher end still spending, going nuts. Lower end really crimped.
Well, there is certainly a bifurcation across consumers. The lower end consumer is feeling the pressure of economic headwinds. In fact, while we don't operate in the economy tier, they actually had negative revenue per available growth in the second quarter. But as you move up the chain scales, we are seeing continued strong RevPAR growth, really across segments and across geographies. In fact, the strongest growth we saw in Q2 was in the luxury segment. And so that luxury customer continues to spend, continues to have confidence, and continues to prioritize spending on travel and experiences versus hard goods.
Can you give a sense of, in the non-luxury segment, where consumers are pushing back, what they're not willing to spend on in the same way that they were, say, a year ago?
Yeah, so it's really interesting. If you look at our Q2 numbers, with the exception of Greater China, which I know we'll talk about, we saw strong growth across every geography and across all three segments we operate in: business transient, group, and leisure. So it's not that we're seeing really a pullback in travel. We are seeing a little bit of a level of caution in some of the related discretionary spend. So when you look across most of the markets we operate, food and beverage spending, for instance, was down a bit. So those consumers, it appears, are still prioritizing travel, but maybe they're being a little more judicious on their spending as they travel.
Well, Tony, you've been with Marriott for a few cycles, joining in 1995. I wonder, when you look at the consumer now and some of that concern, that pickiness of what you're seeing, how similar or how far away does it look from past downturns?
I think, well, from a macro perspective, not terribly dissimilar, other than the trend I just mentioned to Lisa, which is we have great credit card partners in American Express and JPMorgan Chase. And so we have really rich consumer spending data to evaluate. And pre-pandemic, you saw some of the younger demographics starting that shift away from purchase of hard goods towards experiences. Post-pandemic, it really appears to be across demographics. And that's a trend that seems to have the legs to endure long beyond the end of the pandemic. So I think that's a distinction. For Marriott, we're a different company than we were in different cycles. A higher percentage of our business is franchise versus managed, so you don't have that incentive management fee volatility. Higher percentage of our revenue comes from non-RevPAR related sources, like our branded residential business, like our branded credit card business. We're much more international than we were in previous cycles, but there are certainly some similarities.
And you have yachts now.
Now we have yachts. In fact, Ilma, our second yacht, launches next month.
Well, I'm just curious about this idea of investing in luxury. How much of this do you say, this is just of the moment, the split we're seeing, or we want to buy more boats? We want to have Marriott private jets in the sky. What does it mean to either just continue on the trend or double down on it?
Well, the good news is we're not buying any of it. You know, we're an asset-light model, so we have terrific partners who are investing meaningfully in luxury. And we want to lengthen the lead that we enjoy in luxury. We've got the industry's largest luxury footprint. We have the industry's largest luxury pipeline. We have the industry's largest luxury branded residential business. And yacht is just a natural extension of that. We find that luxury customer wants to spend a higher and higher percentage of their travel wallet with the brands that they really trust. And when we look, again, it's more anecdotal because we've only been in the water for 2 years, but more than 50% of the passengers have never cruised before. And so I think they look at that Ritz-Carlton brand as a little bit of a housekeeping seal of approval. And more than 75% of the passengers we've had are Bonvoy members. And so that 210 million member loyalty platform really gives us a channel to talk to them about our expanded offerings.
Before I move on to international, because I want to ask you about the Chinese consumer, I want to ask you about Hawaii. And I know you have a lot of concern. You put a lot of effort into rebuilding what was going on in Maui after the wildfires. Is tourism coming back?
It is. We just passed the 1-year anniversary of those horrific fires in Lahaina. I had my whole leadership team in Maui just last month. The great news is the Army Corps of Engineers is to be applauded. The progress they've made in cleaning up Lahaina, preparing Lahaina for redevelopment is really encouraging. We had the commander who's running the effort give us a tour of Lahaina. There's a house under construction, which was really important symbolically. But the aloha spirit of Hawaii is as strong as it's ever been. Our people are passionate, they're resilient, they're excited to see tourists coming back, but they're still operating at occupancies in the 60% range. And so if If your viewers hear nothing else, go to Hawaii. They need the business. It's as attractive as a destination as it's ever been.
So who is traveling right now? We spoke to the Four Seasons CEO yesterday who said the Americans are out there and they're traveling. They're seeing weakness with the Chinese consumer. Is that similarly what you're seeing?
Yeah, although interestingly, the high-end Chinese consumer is traveling a great deal, but they're not traveling in China. So when we reported our second quarter earnings, the highest submarket we had in terms of year-over-year RevPAR was Japan. RevPAR in Japan was up 21%, and a lot of that was driven certainly by American travelers, but by high-end Chinese travelers.
But also, how much is that driven by the weakness we've seen in the yen? And travelers want to take advantage of that.
That's the case. But I think that outbound Chinese traveler was locked down in a really significant way. And you've seen the Chinese government create visa-free travel across the APEC region. And so we're seeing strong outbound Chinese travel in Japan, Thailand, those sorts of destinations.
As an American company based in America, does it give you pause to keep the footprint in the size that you'd have in China, given some of the overlay of tensions between the two countries, as well as the lack of appetite to go beyond that APEC region by Chinese wealthy travelers?
Well, I have an expectation eventually they will come back. If you think about pre-pandemic, the growing middle class in China and their appetite to explore the world was one of the things that drove a lot of optimism across our sector. And I think that will come back eventually. To your first question, we've got a little more than 500 hotels in China today, nearly the same number in our pipeline. And almost the entirety of that portfolio is owned by Chinese companies. And so I'm not sure we're necessarily viewed as an American company in China because the assets are owned by the Chinese. And they love global brands like Marriott. And so, of course, our business thrives in times of political stability. And when you have ratcheting up tension between the U.S. and China, that's not great for travel. But our demand levels in China are back to pre-pandemic levels. The reason we reported such weakness in RevPAR is because of rate. And rate is soft, one, because a lot of the high-end Chinese consumers are leaving China to travel across the region. And the booking window, because of weak consumer confidence in China, believe it or not, is under 3 days. And so they're making those decisions very close to travel for in-country travel.
So just to tie this all together, I know that Marriott had a subdued kind of outlook going forward in terms of how quickly you can see some sort of normalization or at least reversal of what we've seen, particularly in the lower end consumer. How deep do you think some of the weakness goes, the reluctance? I mean, is this just a matter of economic uncertainty, or is this something that you're seeing escalate in a more significant way?
Well, I think your term normalization is the right one. Remember, we saw our business drop by more than 90% in the early days of the pandemic. So for the last couple of years, you've seen demand come roaring back. The benefit of those really favorable year-over-year comparisons has faded, and we're settling into a more normalized demand environment. Weakness in the consumer obviously hits our business. We operate in a cyclical industry. But I think everybody's waiting for September, and if the rate cuts that are expected materialize, that'll be a boost for the consumer. Obviously, I'm going to be watching you at 8:30 to see what the inflation numbers look like. But all of that factors into that mindset of the consumer. But the thing that gives me confidence beyond the next quarter or two is this almost sociological shift we've seen with this appetite for travel. And I think that bodes really well for our business.
Tony Capuano, thank you so much.
My pleasure.
Always wonderful to have you
Anytime.
on the show. Marriott International President and Chief Executive Officer Tony Capuano, thank you. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. Germany's public prosecutor has issued an arrest warrant for the suspect alleged to be involved in the 2022 attack on 2 Nord Stream gas pipelines. German authorities have been unable to bring into custody the suspect, who is a Ukrainian diving instructor currently living in Poland. The suspect told the German media outlets he was surprised by the accusation and denied being involved in the attacks, which damaged both strings of the pipeline in the waters near eastern Denmark. Japanese Prime Minister Fumio Kishida won't run for a second term as leader of the long-ruling Liberal Democratic Party in September. Kishida said in a news conference he will devote himself to supporting the new leader selected through the presidential election. Kishida's successor will be Japan's 3rd prime minister since the late Shinzo Abe stepped down in September 2020. And Apple's main manufacturing partner for its iPhone said it expects revenue to grow in the current quarter and for the rest of the year. Hon Hai, also known as Foxconn, reported a 19% jump in revenue for the quarter, surpassing estimates. That boost helped in large part by its growing business of supplying data centers with servers containing NVIDIA AI accelerators. Plus, a pickup in shipments of the iPhone in China have reversed a slump in recent months, a boon for Foxconn. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, counting down to CPI.
You still do have inflation that's above target, but I think inflation risks have really dissipated. And so I think the Fed should be very comfortable cutting rates.
That's coming up next. This is Bloomberg Surveillance. We are seeing a market that is in deep wait for that CPI print coming up in about 45 minutes time. You do see, though, the real action today is on the currency front, with the euro the strongest versus the dollar going back to the beginning of this year. Under surveillance this morning, counting down to CPI.
You still do have inflation that's above target, but I think inflation risks have really dissipated. And so I think the Fed should be very comfortable cutting rates. So if the Fed were to go by 25 basis point increments rather than that, yields would rise. Maybe you see equities come down a little bit. But I'm skeptical that the Fed, being a little bit more hawkish, is going to tighten financial conditions aggressively. And the reason is the only way that they would do that is if the economy is looking resilient. And I think the market is highly leveraged to negative news on the economy.
Here's the latest. Less than 1 hour away from a crucial inflation report, the first of three key economic data points that'll set the stage for the Fed's next rate decision on September 18th. Charles Evans, former Chicago Fed president, I'm so pleased to say, joining us now. Charles, thank you so much for being here. I want to start with really the debate that we've been having on the show this morning, which is the Fed behind the curve or ahead of the curve if they cut rates in September?
Well, good morning. That is a great question, and I think the Fed is in an okay place right now. I think that they have spent a lot of their time indicating that they need confidence that inflation is going to be on a sustainable path to get to 2% inflation, and I think that's a stiff performance bar. I think back in January they were nervous that so many people thought that many rate cuts were ahead, and then the inflation path in the first quarter was bumpy, but they appear to be much better. The last press conference, Jay Powell indicated that inflation progress was welcome. And, everybody's expecting a better number this morning. So I think they're in a position where they can respond to the improving inflation data and, the normalization in the labor market and a bit of nervousness with the fact that unemployment has gone up. But I think it's time for them to, really start talking more about how they're going to act and actually act.
Charles, you have the luxury right now of not actually having to represent the Federal Reserve, and you could talk about what your impression is of market positioning. So let's go there. The fact that the market has pretty much full confidence that the Fed is going to cut at least 3 times, probably 4 times this year, 100 basis points of rate cuts. We were speaking earlier with Justin Cole, who basically was saying, why? There is no sign that they should be cutting rates given the fact that the economy still is strong and the labor market hasn't turned over. What's the argument to go now, given that we're not seeing a negative print on jobless and on jobs creations?
Well, the funds rate's at a restrictive rate of 5.3%. They set that in July of last year, and inflation has come down. So by its real measure, it's only gotten tighter since they took those actions. Inflation has come down. If you look at a bunch of benchmark policy rules that the Fed looks at, they don't follow them necessarily. I mean, they certainly don't follow them in lockstep, but they're a guide as to where policy likely would be headed. And they are far south of where we are right now. I think I saw something where John Taylor said that his rule says that the Fed should be at about 4%. That's quite a long ways. Jay Powell has said that the labor market is normalizing, and they seem to have more confidence that the labor market is only normalizing and not doing worse than that. Even though the unemployment rate has gone up, it's 4.3%. Now, maybe the most recent increase was for some positive factors like increases in labor force, but it has increased by, substantially. And the unemployment rate usually it either goes up or it goes down. And when it's going up, it usually keeps going up. And so it would be quite sensible from a risk management standpoint to sort of take an initial action and step down somewhat from the restrictive level of 5.3%.
Along with what they should be doing, there's also a matter of what they should be saying. And at least from the more hawkish members, Bowman, Bostic, kind of pushing back, saying we need more evidence. Charles, you take this view that your fellow peers, that they aren't guiding well at this moment. What would it look to be guiding better? What would you want to hear from the FOMC at this moment?
Well, I think so the Fed has really relied on this rhetoric that they're not about to cut rates until they have confidence that inflation is going to come down sustainably to 2%. The Fed doesn't have a lot of experience with maintaining sustainable 2% inflation. We kept inflation under 2% at 1 3/4 for a number of years. If that's the definition of sustainable, then I can understand why they need the restrictive stance of policy in order to be confident. But I don't think that's what they really mean, or they should mean. And I think that the increase in the unemployment rate has got to make you a little bit nervous. At 5.3%, the Fed doesn't have a lot of history of being able to, they don't have any history of being able to cut the funds rate at a measured pace in these 25 basis point increments on a quarterly pace that the SEPs have. What you have more likely at a peak funds rate like this is January 2001, where all of a sudden they realized they needed to be nimble and cut by 100 basis points within 2 weeks. And January 2008, where we cut by 125 basis points in the course of 2 weeks as well. And so I think it's just risk management that you would want to step off of this really quite restrictive 5.3% stance and as nimbly as possible communicate that this is just sort of a readjustment and you've still got your eyes on getting inflation down. It's just you don't need as much restrictiveness as they have in place now.
Well, one of the kind of criticisms that's lobbed at the current FOMC is this idea of recency bias, that they were behind when it came to try and combat inflation on the way up. So that sort of scars from that moment means that they don't cut as soon. Charles, you've been in the room where these decisions have been made. Do you think there's any credence to that argument?
I think that, one part people often say, you need to be humble. The Fed needs to be humble. There's a lot of uncertainty out there. I think part of humility is being embarrassed when things didn't go the way that you thought they did. And so when inflation went up to 7% on the PCE, and I was part of this in the committee, and I was saying this looks like it's transitory. It's not going to last. It's not. It was persistent. It was very persistent, but it has come down. It has come down without unemployment going up. The playbook normally would have been you really need a downturn in order to get inflation down from 7%. We're at 2.5% on the PCE, core PCE. That's remarkable. And it's because of an unwinding of the supply factors. And so I think that it is difficult to look past the fact that I think they had their eyes on the ball. I think Jay Powell, in increasing the funds rate very quickly in 2022, got ahead of the curve. Certainly got on top of the curve better than the other foreign central banks. But it's hard to give up on this idea that you let inflation get away from you in 2022. Gosh darn it, you just got to get it down to 2.0 and it's got to be sustainable. I think that's very aggressive. But that seems to be what they're thinking about. I'm not in the room with them, and I'm trying to understand from their communications what they really mean by this sustainable 2%. And I think they could use some clarifying on that.
Charles Evans, former Chicago Fed president, thank you. We will try to get some of that clarifying for you and for everyone else. Coming up in the next hour, Gargi Chaudhuri of BlackRock, David Kelly of JPMorgan, and Stephen Ricchiuto of Mizuho, as we do count you down 35 minutes away from CPI. Dana, do you wonder how much the CPI print could shake up markets that are really attenuated to this idea that the Fed can cut rates?
Yeah, they front run themselves, certainly with that PPI, if not from the weak labor market. 200 basis points worth of cuts priced in for the next year. What happens if the number's hot in just a few moments' time?
The reason why few people are taking bold bets right now, given the fact that the market is pretty much unchanged, where you do see action, a weaker dollar, as people anticipate, regardless of what happens. This is a Federal Reserve that's going to cut rates. This is Bloomberg.
not really concerned at all about inflation staying too high.
You still do have inflation that's above target, but I think inflation risks have really dissipated.
Inflation expectations are slowing down with the economy.
We see slower growth, which is a necessity to cool inflation.
The restrictive aspect of policy is working. I think we're going to see a moderating inflation.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
30 minutes until U.S. CPI. Welcome back to Bloomberg Surveillance, where we're counting down to one of the key data points that we get this week. Anne-Marie Hordern, Danny Berger, I'm Lisa Abramowitz. John Ferro is off this week. He'll be returning on Monday. We are about 30 minutes away from that key metric at a time when a lot of people are saying, Danny, and I think this is really the key question that we've been having all morning, is the bond market overpricing how much work the Federal Reserve has to do to keep this soft landing on track?
And I'm really interested in what the reaction is of this bond market. If it's 3%, 2.9%, if we see 2.9, do we get another big leg higher in this rally in this bond market? And does that make sense? If inflation is coming in, it doesn't mean recession. And the bond market is screaming recession, maybe not screaming, loudly saying recession at this point. JPMorgan says the market's pricing in 30% odds of a recession. Is that in line with reality, regardless of what CPI does today?
And one thing that's been hard for, I think, all of us to square, and I think, Anne-Marie, you've done a great job of bringing this out with pretty much every consumer conversation that we've had. Is it sustainable to see the higher end, the wealthier individuals continuing to do just fine and be able to travel and spend, or the lower income classes are increasingly having difficulty in pushing back in the consumer spending realm?
Well, you see this in the polls, right? Inflation is the number one issue going into election. This is the first of 3 CPIs we're going to get before November 5th. But when you hear from corporate earnings, Mohamed Al-Erian always said, listen to what corporations are saying. What are the CEOs saying? They're saying that they're still seeing that resilience on the upper end. The resilience is really starting to crack on the lower end. And I think that's why this CPI is really important.
Although maybe not enough to bring down inflation, which is sort of the key metric as we look forward to this. At a time when we already have seen a pretty big move, let's take a look at some of these moves. In the 2-year yield, we have seen 30 basis points of decline since the end of July. We have seen a 4-day winning streak on the S&P 500 that has been the biggest going back to November. We have seen some of the biggest tech names deliver incredible performances. I'm thinking, for example, of NVIDIA with a 17% gain in the past week alone. This has been the other sort of existential angst, Danny, which is how much are we right back to where we began before that sort of volatility really got kicked off?
Well, the volatility is also just kind of the point, even though we're back to where we were. And you can see that clear shift in the markets from all calm, from every day kind of inching up to a new record. That stopped last month when we got the CPI report. The CPI report was that threw everything kind of into the wind, where you get a big, powerful small cap rally that undoes itself. You get 2-year yields going from 4.5% to under 4%. So it was a change in this market as we try to grasp onto trends. And as we try to do that, there's just this incredible chop. So does today help us find the direction? Does today help us? Or maybe it's just tomorrow, Lisa. Maybe it's just retail sales and a jobless claims print that we really should be caring about.
Or maybe we just won't get direction for a while, which is the unfortunate reality that we've been in for quite some number of months. Coming up this hour, I'm so pleased to say we've got Gargi Chaudhuri of BlackRock as markets do hold steady ahead of that CPI print. Steve Ricchiuto of Mizuho on why he thinks the U.S. economy is still healthy. And David Kelly of JPMorgan on why the Fed's 2% inflation target is within reach. I love having them together because they kind of oppose each other with respect to where we are in this recovery story. We begin with our top story. CPI out in just under 30 minutes. The S&P 500 notching a 4-day winning streak as traders anticipate another soft data print on the back of PPI. Gargi Chaudhuri of BlackRock saying this: the risk to the market remains hotter than expected inflation data and weak retail sales that would put the Federal Reserve in a bind. While growth risks have increased, we believe the market has overreacted to a small number of soft data points, not a drastic change to the macro outlook. Gargi joins us now. And Gargi, I want to dig into that a little bit. Where is the biggest overreaction right now in markets?
Good morning. It's so great to be here. Thank you for having me. So I think that the overreaction, especially in the beginning of last week, was certainly in the massive repricing we saw in the bond markets with the warp screen pricing in all of those 50 basis point cuts, which just did not seem likely, given just the week before that, we had heard from a very resolute Chair Powell that they're going to be dependent on the totality of the data. So I think, obviously we've unwound some of the moves. That's great. As you know, we've liked fixed income for a while. Even with us having liked fixed income in the belly of the curve as much as we did, it felt like too much was getting priced in terms of, Danny, as you were saying earlier, the market screaming recession risks. And frankly, when have we ever cared that much about the ISM number, right? So I think there was a little bit of an overreaction, and thankfully it has unwound. So now looking ahead, I think what we need to see is continuation in terms of that inflation easing, which we'll see in 26 minutes. And I think we'll continue to see that the labor market is moderating, but not falling off a cliff. And I think that's what's going to drive equities and bonds from here.
What's the bigger risk today to markets, considering how people are positioned, that we get an upside surprise or a downside surprise to inflation?
The bigger risk, I guess it depends on how you're thinking about bigger risks, but I suppose for the equity markets, if we get a very shocking high 0.3 print, and God forbid a 0.4. Again, that is obviously not the expectation across the street. Everyone's expecting sort of a softish 0.2. But if we meaningfully overshoot that, I think that's going to be a problem for the equity markets and bond markets. And then if we follow that with a retail sales that's a little bit cooler than expected, and the market's already expecting a cooler than expected retail sales, but if it's even weaker than what we've seen, I think that is a big risk to the markets. And let's not forget, we're still in the midst of some geopolitical risk. There can be headlines anytime. We still have elections, not that far away, which historically hasn't been good. This is the weak seasonal period for equities the next couple of months. So I think there is a few risks out there.
Gargi, I mean, that's so many things to even just keep track of, let alone just trade on. In these moments where the pendulum swings so fast, and there are other risks from the outside, geopolitical, that it could potentially impact things, what do you even do? Is there somewhere that you can hide during this noise?
Yeah, so what we've been telling investors to do is sort of hide in the highest quality parts of the market. So the one thing that we saw last month after CPI was this, after the weaker than expected CPI, was this huge bid to small caps. And, at that point, we didn't feel that was appropriate. And again, if today we get a softer than expected CPI, if the same thing happens, I would still say favor up in quality. And then I would also say that look for some downside protection, especially over the next 6 to 8 weeks, given how much we've rallied in equities. And, we've talked a little bit about buffered product. We've talked a little bit about minimum volatility. We've also loved owning the belly of the curve. So I think all of those still make sense. I would just say that between now and call it October, November, I think we might continue to see a little bit more volatility than we've historically seen, especially the last 8 months of that straight line upwards.
That bond call I find in particularly interesting, because it is this tension of maybe we're priced as rich as we can be at this moment, but people are still hiding out on bonds. Last Monday, when you had the wreckage in the equity markets, people fled to bonds. So how do you think about the interplay between the two?
Absolutely. And this is such an important question because on one hand, I talked about how too much was priced in the very front end. On the other hand, I've been on this show before and talked about how the long end of the curve doesn't have enough term premium priced in. So where you want to be focused is sort of that belly, which is the 3 to 7 year part of the curve, which is what we've been telling investors, and also focusing on active investment where you're putting your money with a portfolio manager that can rotate between high yield and emerging markets, or CLOs, and other parts of the market that are attractively priced and getting you a significant income. So I think looking at investments which are in that belly of the curve still makes sense. I think the front end moved quite a bit. And I also think, and this is important, some of that negative correlation to equities is coming back. And we certainly saw that in the bond market last week. And that's great news for investors. I think there's a lot of money on the sidelines. You're not going to keep getting that 5% that you were getting in cash. It's time to step out into bonds and high quality equities.
Gargi, you brought it up, so I want to go there. You mentioned the uncertainty ahead of the U.S. election. We've had mixed reviews from individuals coming on the program saying whether or not last week we actually saw an unwinding of the Trump trade. Do you think that was some of it?
I think that last week was all about the unwinding of the carry trade. I think that was one thing that was loud and clear. It was the yen carry trade that got unwound. I don't necessarily think it was an unwind of the Trump trade. I do think that as of right now, when we look at what the yield curve has more or less been doing, not every day, but the steepening is something that makes a lot of sense regardless of what happens in November. I think that's going to probably continue to be the case, and you can point that to Trump, you can point that to Kamala. I think I don't think it matters one way or the other. I think the steepener is a trade that we like. Broadly, what we're telling investors to do is sort of focus on areas of the market that are a little bit more bipartisan. So things like infrastructure, things like tech independence, those we think are going to win in a variety of outcomes. And I think that we also need to tell investors that historically, going into elections, we've seen a little bit of volatility. So stay invested through the volatility, but stay invested up in quality.
You mentioned what you're telling investors. When you walk in the room, is this the first, second, third question they ask you?
It's the first. It's definitely the first. Maybe not last week. Last week it was the 11th. But usually it's one of the things that is top of mind, especially in a world where cash is yielding 5.3%, right? So when investors and clients are allocating to cash, that's an investment decision. That is not a I am so scared decision, which was the case in COVID when cash was zero. So what investors are asking, what clients are asking is, well, I'm doing so well in cash and we have election risk and we have geopolitical risks. So now what? And I think it's all our responsibilities to make sure that they understand that if you're investing in cash now, you might not get in 1 year what you are getting today, because we all expect cash rates to be lower. And then the other thing is you are giving up on these other really ripe opportunities, especially in the belly of the fixed income markets with something like BINC that you can get 6.5% to 7%.
Just to sort of put a bow on this, if we do get a soft CPI print and we do see that the Fed does have a green light to cut rates in September, how much cash do you see flooding away from money market funds into bonds, into either the belly of the curve or into corporates or even into risk assets?
Look, July was a fantastic month for inflows into fixed income ETFs. And this was just the beginning, we think, of investors continuing to pour into fixed income. And again, it can be the belly, it can be longer end, just moving away. What we also know is that in the US right now, there's around 5 trillion, globally around 8 trillion of cash. Some of that will remain, but some of that will eventually recognize the opportunities. And I think if July gave us a little bit of an insight into what the rest of the year, especially when the Fed actually starts moving, I think this can continue to be a really great year for fixed income.
Gargi Chaudhuri, thank you so much for being with us. Gargi Chaudhuri of BlackRock joining us here in New York. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Haques. Yahaira.
Hi, Lisa. The world's biggest single owner of equities reporting a strong performance in its investments for the first half of the year, with a big thanks to big tech. Norway's $1.7 trillion sovereign wealth fund reported returns of over 8% in the first half as stocks surged. The fund, which owns stakes in nearly 9,000 companies worldwide, said that it paired its stakes in Meta, Novo Nordisk, and ASML during the first half of the year. A spokesman announced the fund will now release updates on what is in its portfolios twice a year. Global oil prices are rising after an industry report found a sizable drop in U.S. crude stockpiles. The American Petroleum Institute reporting inventories shrank by 5.2 million barrels last week, according to people familiar. That would be the 7th straight weekly drop if confirmed. Elsewhere, risks remain that a retaliatory strike by Iran on Israel may lead to a spike in oil prices. The U.S. said that the probability of an attack has increased, that it could come as soon as this week. And activist investors are pushing hard for sweeping changes at Southwest Airlines. Elliott Investment Management has nominated 10 of its own candidates to the board of the struggling carrier. They include the former heads of Virgin, WestJet, and Air Canada. Elliott has previously demanded major changes at Southwest, including ousting CEO Bob Jordan. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, the morning calls, plus Steve Ricchiuto of Mizuho as we count down to CPI. That's coming up next. This is Bloomberg. 15 minutes and 7 seconds until that key report, the CPI, that may or may not move the dial. Right now, markets pretty much in a range as they anticipate that key data point, 54.60. Just amazing how much we've retraced. I want to just take a second on this, Danny. The idea that we have rebounded entirely the volatility that we saw and then some, that we saw NVIDIA up more than 17% in a week.
It is madness. It's also madness within that time period. You get NVIDIA swinging intraday up a couple billion, down hundreds of billions. And then you get Japanese stocks that suffered their worst day since 1987, less than 2 weeks ago, and is back around. It is flat. To see that kind of volatility and just take a step back and say, if you were on vacation, you would have missed it, is kind of an insane thing. It's kind of insane because so many people said volatility clusters will continue to get it. And we just haven't.
Insane or wonderful, pick your poison. Time now for the morning calls. First up, Wedbush upgrading Chipotle to outperform. The analyst saying the chain can sustain market share gains in a challenging macro backdrop for restaurants. Next up, Baird upgrading Starbucks to outperform with a price target of $110, calling incoming CEO Brian Niccol an exceptional executive, inciting his brand management expertise. And finally, Citi cutting its price target on CrowdStrike to $300. The analyst saying reputational damage from last month's global IT outage appears contained. U.S. CPI just moments away. Joining us now is Michael McKee, Bloomberg economics and policy correspondent. So will it be 0.2% or 0.21%? How big of a difference will it actually make, Mike?
To the Fed, it won't make a whole lot of difference, but the rounding numbers could make a difference to the markets in the way they interpret this off the top. Obviously, people will go through these numbers and reposition themselves, but every time we get a number, it's like a roulette wheel. We're waiting to see where the ball drops. You're either on red or black, and then you trade on it. So, yeah, that could make a difference. I think the biggest thing that people are going to look for is, do we see continued progress in the areas in which the Fed is wanting to see continued progress, like housing, and the other issues like airfares and used cars and things like that. So if inflation continues to show some progress, that's going to be good enough. We don't have to have what we had last month, which was a big surprise lower.
Talk to us about sort of the confidence that we can take in CPI numbers. And I ask because every single month, every single CPI day, Paul Donovan at UBS comes out and says, these numbers are made up. OER equivalent rent is a fantasy number. Why are we still paying attention to that? Yeah. If we look at the CPI numbers now, how much confidence should we take should they come in softer?
I was reading Paul's comments earlier, and the only thing you have to say is, OER is kind of a made-up number, but it also works the other way. I mean, it pushed inflation up, maybe inaccurately, when we were going through the higher inflation time. So it kind of works both ways. But there is a good point there, and that's one reason that Jay Powell emphasized Supercore, services without housing in it, because we know that the housing numbers are kind of weird. And Supercore has come down a lot as well. The question is, what do we see this month? And it only becomes really important this month in the sense that everybody's waiting to see what Jay Powell will say next week, which may be informed by what happens today. And then we get another CPI before the next Fed meeting, so this isn't going to be dispositive.
Mike, when it comes to potentially, is it the fact that they need to see lower inflation data or just more inflation data? Because Stuart Kaiser is saying how that's one reason why he doesn't think this CPI report is actually that important. They just need to see more of the data, as long as it's not completely out of bounds.
Yeah, I mean, I think that's true. Even the hawks are making the point that, yes, we can cut rates if the data continue to show us what it has been showing us. And that's the expectation, that we will see continued progress, even if it's only incremental.
Michael McKee, stay close. We're going to get that data in just about 9 minutes' time. Right now, ahead of that, we've got Steve Ricchiuto of Mizuho. We are so pleased to say on set, ready to go. So really, the key question for a lot of us, and we've been debating this all morning, how important is the CPI print?
This morning's number, not particularly. I honestly think this Fed has opened the door to cutting rates as wide as you can open it. They have gone through 3 iterations of opening the door. First, they raised the inflation target. That would be consistent with cutting rates. Then they lowered the unemployment rate. That would be consistent with cutting rates. And then Jerome Powell basically said that all we need to do is see data stay where it is and we can cut rates. The interesting thing is the market's reaction to that and then the pushback that's come from some other members of the committee. I think when you're looking at what Jerome Powell keeps on telling you and you'll contrast it to the policy statement, there is a difference of opinion within the committee. And Jerome Powell is clearly lining up on the dovish side of the committee.
Does that difference hold them back? If they need to cut in a month, which is seen as highly political, do they need everyone in agreement if they are going to be cutting in September of all months?
I think the chairman really would like to have a unanimous decision. I don't think he wants to go into a meeting and have more than one dissenter from the decision, especially because of the proximity of the politics, especially because some of the statements that have been made by, former Federal Reserve presidents of New York, Bank of New York, a supposed principal economist in the Federal Reserve System. These kind of, statements have amplified the political nature of this. And therefore, I think he would like to have unanimity in the process in order to decide this is something that was not a political decision.
To get that consensus, what do we need to see in the data?
That's a darn good question. I think a decline in terms of the year-over-year growth rates would be very, very helpful for them. But you remember, we're still in the 3s on the year-over-year numbers in this particular measure. We're not in the PCE deflator. But again, that PPI number that came out yesterday argues that some of the key components of the PCE number that come out later this month are not going to be as friendly. And year over year, we're starting to move higher in the PCE numbers. So I think what we're getting into is a very tight window where, the prospects of cutting rates have increased dramatically because they really have wanted to cut rates forever. And they get to the point where they sit there and say, well, if we don't do something, then what are we here for? And that's kind of the position they've gotten themselves into, unfortunately.
So if you're not necessarily intimately connected to the alphabet soup of PCE, PPI, the different components, et cetera, there is this sort of bigger takeaway that actually makes all of these points very relevant. And the reason why I care so much about them is that essentially there is a debate right now. Are we at a greater risk of a reacceleration in inflation or outright deflation even, akin to what the problem was before the pandemic? How much are you arguing that it's still reacceleration versus the disinflationary spiral that a lot of people were gotten used to saying was actually a negative thing not so long ago?
Disinflation, global deflation pressures are real. You don't have to go much beyond the top line of the news services reports on the different countries around the world and what they're experiencing to see that. The question is whether or not it gets translated into U.S. inflation. And this is where the currency becomes critical. And if you notice, yesterday was a pretty disappointing day for the currency. We moved to some exceptionally low levels. So the currency could easily offset the global deflation risk because that's all concentrated in goods prices, where services are driven by domestic forces. And domestic forces are being driven largely by the labor market. And this Federal Reserve wants to keep a labor market very tight. So you argue that there is this great debate that's going on between the domestic cyclical inflation and the global deflation. Which way we pan out? Unfortunately, it's up to the currency.
It's a great point, especially when we have the euro 110.27 versus the dollar, which is the strongest level going back to January 1st. And frankly, there's a lot of debate around this in terms of globalization and what that does. Vanguard just put out a really good paper on that, questioning the sort of disinflation of globalization. We don't want to get into that right now. Steve Ricchiuto of Mizuho will be sticking with us. Michael McKee also, all coming up next. We will be breaking at CPI. David Kelly of JPMorgan will be joining us with Steve. We love having them on. They can go against each other about where the balance of risks is for the Federal Reserve. This is how we're stacked up ahead of that print. We're expecting a 0.2% CPI month over month. That is up from negative 0.1%, but still on that downward trend, potentially opening the door to the Federal Reserve's rate cut. This is Bloomberg. We just have seconds to go before that CPI print. Here is the state of play heading into that. Not a whole lot going on in markets after a pretty eventful 4-day streak. We are seeing, though, a little bit of a pop across the board. The Russell 2000 outperforming, and this is the reason why. 2-year yields continuing their descent, as well as across the board, although actually picking up a little bit, just fluctuating there, 394. Right now, we do have the economic data with U.S. CPI coming out. Here is Michael McKee.
And economists got this one right. Bang on. 0.2 increase in the core, 0.2 increase in the headline, just as forecast. Now, base effects are somewhat hard to measure. So we do see, even though we're in line with the headline number, we see it drop on a year over year basis to 2.9% from 3%. That is better than expected. And 3.2% on the core on a year over year basis. That is also better than expected. And that may have to do, and we'll look this up, with the rounding that Lisa was talking about before we came on. Taking a look at some of the numbers here, we see food prices up 0.2, same as last month. Food has really come down as an overall issue. Gasoline prices were flat on the month. We saw in the PPI, remember, that gasoline prices were up, and that pushed overall goods prices up. New vehicles down 0.2, and used cars down 2.3%. Those are kind of as expected by analysts. Shelter costs up by 0.4. That's double what we saw in June. We'll have to see how that breaks down. I'll take a look at that while you guys check the markets. But that could be something that maybe worries people a little bit if it turns out to be in the home price area.
We'll give you a second to go through some of the details right now in markets. Hard to know exactly what to do with this. That's my takeaway. Although marginally, a little bit of a pop on the S&P 500. Bond yields kind of fluctuating, although a little bit higher. Right now, you do see an ongoing pop in that Russell 2000. Danny, that to me really stands out with the idea of rate cuts. This not necessarily impeding the prospect that the Fed will move in September.
I think here you kind of see the clear divide of how we went into this. The fact that you had bond markets in the front end rallying so much, it's undoing some of that. This morning, the front end is moving higher by about 4.5 basis points, which you wouldn't think if you saw small caps taking off. So maybe it is just the fact that we did see, some differences in between bond and equity markets, that you did see bonds, again, price in already some very, very significant Fed cuts. So maybe it needs to undo it with a report here that's, basically in line.
Yeah, basically not a lot of dramatic action, and euro dollar pretty much staying around that 110 zone. Mike, you've had a couple of seconds. You get a couple seconds here on Camp Surveillance to parse through the numbers. What stands out for you?
Well, in terms of this housing question, it isn't particularly good news because the Fed had been hoping we were now going to see a series of lower inflation levels. Shelter, as I mentioned, comes in up 0.4, rent up by 0.5%, and owner's equivalent rent up by 0.4, which is a reversal of the decline last month to 0.3. So housing a little bit more expensive, and it is not what the Fed wanted to see. I'll continue to parse through this while you get the reaction of people who are smarter than me and certainly better looking, and we'll see what else we find.
All right. Well, joining us right now, we've got David Kelly of JPMorgan alongside Steve Ricchiuto of Mizuho. David, thank you for being on with us. I want to start with you. What's your reaction to this?
I think it's pretty good news because if you look at first of all, it was slightly better than consensus in the headline. Very slightly. But if you look at what's still holding CPI up, we got a 1.2% increase in auto insurance. So it's still at an auto insurance anomaly there. And we did see a 0.5% increase in rents, but that's showing the rental numbers up over 5% year over year, and owner's equivalent rent up over 5% year over year. Now we know that is somewhat misleading, and I think the auto insurance number is also somewhat misleading. But everywhere else, inflation is nowhere to be seen, and I think that's really the important point. Where in the actual transactions markets of the economy, where people are sort of bidding and asking for in terms of prices, inflation is disappearing. So I think that overall, this very much confirms the idea that inflation is heading down. I think over the next 2 months, we're going to have some relatively easy comps. So I think that by September, the Fed may actually hit its 2% year-over-year number on consumption deflator inflation. We'll see what happens. But overall, I think this is further confirmation that inflation is gradually whittling away.
So inflation problem dead. Steve Ricchiuto, your take?
complete opposite view. I don't think you should ignore things like what's happening in insurance rates. I don't think you should ignore things like what's happening in the housing market. I think what you're really looking at is an index. You take the index for what it is. You don't parse through the components, throw out what you like, and throw out what you don't like, keep in only what you like. This is a problem that we have over and over again. This is a problem we have with people who want to look at a particular component like an unemployment rate or a yield curve and make macroeconomic forecasts out of it. The reality is it's a little bit like Chicken Little getting hit in the head with an acorn and saying the sky is falling. The reality is these are individual components, but they're individual components of a larger aggregate set of data. And that aggregate set of data is telling you, A, the unemployment rate is still low. B, wage gains are still happening in the economy. Inflation is not near the Fed's target. It's still 1 percentage point above it at the CPI level. At the PCE level, it is lower. And it's telling me that we have an economy that is still very, very healthy. So, again, they want to cut rates. They're probably going to cut rates in September because they've opened the door wide enough to, bring a Mack truck through it, or should say bring the Queen Mary through it. And the net result is they'll get what they want. But at the end of the day, is it going to have much macroeconomic effect one way or the other? To be honest with you, it's going to affect financial markets much more so than the underlying macroeconomic environment.
David, I just want to give you a chance to respond to that.
Yeah, well, as Steve and I have just got a slightly different view of this. I don't think this is an inflationary economy. I realize the labor market's tight, even with the unemployment rate up at 4.3%. But what's remarkable is how much wage growth has fallen very steadily all the way since March of 2022. And what that tells me is it doesn't matter how tight the labor market is. American workers are just not demanding huge wage increases. They're just not doing it. We're not seeing massive numbers of strikes. We're not seeing massive industrial action to try and get wage increases. Wages are still rising more than inflation. But if you look at core goods, if you look at food prices, you look at energy prices, none of it shows inflation picking up. So we're heading back towards 2%. Inflation is cooling. It's cooling slowly. But I think the greater risk right now is the Fed. I think the economy is in a soft landing. It's in a good place. But if I'm the Federal Reserve, I want to try to get back to normal here because the risk of recession, I think, is greater than the risk of any resurgence in inflation.
David, not that this is a competition between you and Steve, but if the market had a vote, it would probably be voting with Steve right now. Front-end yields are moving higher by about 5 basis points. You're looking at equities giving up on their gains, except for small caps. That, to me, seems like a market that is saying, hang on, maybe the Fed can't cut as much as we thought it was going to. What do you make of that reaction?
I think, well, the thing is that I do work the details on all these numbers, and I was kind of surprised the consensus was as optimistic as it was in inflation. But I think people are looking for, at this stage, they want, okay, if we get a negative surprise in inflation, then maybe we can price in some more Fed rate cuts. If we get something close to expectations, then we'll sort of sell the news. And I think that's what's probably going on in the bond market. But it doesn't change my view that things are weakening here and on the inflation side. And the really important thing then is, where is the economy looking when we get to September? Because we'll get another inflation report, but importantly, we're going to get a jobs report for the month of August. And that's going to be really crucial here, because if it looks like the economy is softening too much, I think the Fed can look at these inflation numbers, they can study them, they can be confident they're going to head towards 2%, but they don't want to be responsible for holding rates too high for too long and helping trigger more economic weakness. And so I think they'll be looking very closely at what's going on in the labor market and on the demand side of the economy.
So, Steve, David says the risk of recession at this moment is greater where we are than the risk of inflation reacceleration. Do you see that completely different?
Yeah, I don't see a real risk of a recession whatsoever.
But do you see risk of reacceleration of inflation?
If you wind up with an accelerated economy, the answer is yes. And that, I think, is the risk in this scenario. This economy really hasn't slowed much. Look at the GDP numbers. Yeah, we've slowed from last year's 3.3% number, but we continue to exceed expectations in terms of where we're going in the second quarter numbers and what we're looking like eventually in terms of where we are in the current quarter. The Atlanta Fed nowcasters are at very, very high rates of growth. And this becomes an ongoing problem, is that you do run the risk of a domestic cyclical story versus a global deflation story. And this really is the end result debate. We were talking about it earlier. This is the discussion, deflation versus cyclical inflation, globally versus domestically. Where do we pan out on this? David's right. Inflation has been coming down slowly. It's coming down slowly primarily because there is this real battle going on between these two forces. And the problem I see is if you start backing away from the pressure that's allowing you to achieve your target, you might wind up creating an environment where you stop improvement towards your target.
But what would you say to corporate CEOs that continuously say they are seeing this slowdown from consumers? They do see consumers deferring big spending.
Again, after an environment of 3.3% growth, which is a 1 percentage point above trend, you're going to see that inflection point. And that's a real inflection point. By the same token, you have services where spending is doing exceptionally well. And I think that becomes part of the problem. Again, it's the goods versus the services side of the equation. Services are doing extremely well. You're seeing that in some of the components that people want to throw out of the CPI report. The reality is it's services that matter domestically. It's goods that matter globally. Globally, it's a deflation story. Domestically, it's a cyclical inflation story. The currency sits in between the two, and where the currency goes from here will be critical. If we get back to 100 on your DXY measure from having been as high as, 113, 116, that's a huge depreciation in the currency, and you could start to see some of these benefits on the good side of the inflation dissipate at the same time that you may see a little weakening in the service side of the inflation, and you wind up stuck at 3% inflation. Now, if the Fed's willing to be stuck at 3% inflation, fine. Bonds have to adjust to that.
David, we'll let you respond in just 1 second. I just want to, if you are just joining us, give you a sense of where we are right now. CPI month over month coming bang in line, as Mike was saying, with forecasters' expectations, 0.2%. Up from negative 0.1% in the prior month. Across the board, ex-food and energy, 0.2% in line. CPI year over year coming in at 2.9%, just a touch below the expectation, and ex-food and energy 3.2% bang in line. All of this really suggesting forecasters are getting it right. Mike has been looking through the details, the line items that we can debate whether they matter or not. What are you finding in terms of interesting nuggets?
Well, I think part of this plays into the whole political campaign season that we're in now. Insurance prices are very mixed. We do see motor vehicle insurance prices going up significantly. And if you look at X, formerly known as Twitter, I think you said that yesterday, a lot of complaints about that. But homeowners insurance is flat on the month. Medical insurance down just a little bit. So it's not a universal situation. Airfares were down by 1.6%. So if you're traveling, you're going to notice that. And overall, it is housing that has pushed this up. 90% of it was the 0.4 rise in owner's equivalent rent and shelter. And that the Fed can't do anything about. So they're going to have to decide, they'll go back to Powell's ex-shelter measure and say things are getting better. One other political thing, and I know Anne Marie will appreciate this, bacon prices down 1.1%. So that was, I guess, a big issue on one of the candidates' public appearances this week.
Bacon was on your bingo card. Here you go. Thank you so much, Mike. David, Kelly, and Steve Ricchiuto still with us. David, I want to go back to you. And there is this real question about the line items and how much they actually matter versus just the overall aggregate index pointing to a certain type of scenario. What gives you confidence that we are not at risk of reacceleration at a time when, as Steve says, the dollar is actually weakening, and as the Fed is likely to cut, weakening even still?
Well, a falling dollar, although frankly it'd be a good idea if the dollar came down in the long run. It wouldn't, I think the dollar's been too high for too long, but that would add a little bit to inflation. But this is not an inflationary economy. Let's just pick up on airline prices, because I think that it sort of exemplifies the exact nature of the U.S. economy right now. Airline prices are down 2.8% year over year. But if you look at the number of people going through TSA checkpoints, it's up over 5% year over year. It is at an all-time record high. Americans have never flown more than they are flying today. The planes are all packed, and yet the airlines can't actually push up the prices year over year. They've had to push down their prices 2.8%. So, I know Steve is a little more worried about inflation going up. I'm a little bit more worried about the economy slowing down. But so long as we disagree in that way, the truth is the economy is just doing great here. What we're seeing is steady, low inflationary growth, with inflation gradually coming down, and hopefully the economy avoids recession. I do think the Federal Reserve ought to normalize rates to try to remove that risk, because I think they are distorting the economy by keeping rates a little too high at the short end for where the economy and financial markets are. But overall, this economy is in a pretty good place, and I hope that Steve and I are similarly disagreeing as vehemently in a few months' time, because that'll probably say the economy is straight down the middle, doing fine.
I mean, you hear that from the Fed, to be fair, as well, this idea that the economy is doing fine and they have time, and that means that they can just wait for more data. Steve, you look at this data. Is the wait over? Do they have everything they need to cut?
If they could get a unanimous agreement, they will cut interest rates, yeah. And I think you would need something on the labor market to do it. I think, we're arguing today over the CPI number. I think they've already taken that out of the equation. I think it's all about the employment numbers. And the claims numbers, we'll see what the retail sales numbers give us tomorrow. We'll see what the claims numbers give us. People aren't getting fired. What's happening in the unemployment rate is people are coming back into the labor force. They finally used up all that excess savings that most of my colleagues on the street thought they had used up, a year ago and hadn't used up. The reality of the situation is the transition that's taking place from a very abnormal recovery period to an expansionary period is going to be volatile. And reading through all the tea leaves, trying to look at one or two indicators, makes an enormous amount of mistakes. What's important is the breadth of the data within the payroll employment report. It's like the breadth of the data within the JOLTS data, and I'm not a big JOLTS fan. It's the overall aggregate interpretation of the data. And this is what the chairman's trying to bring out. But by the same token, he also then wants to hang his hat on a particular component within a report to say, oh, well, this is what I'm looking at. But the reality is you can't have it both ways. And that's what they're trying to do. And I think that's what the markets are trying to do. They want the Fed to cut rates, and they want the Fed to cut rates a lot, but we don't want the Fed to cut rates too quickly that people begin worrying about a recessionary environment, and then the equity market goes down. So we want to craft an environment where bonds go up in price, equities go up in price, and everybody can go home happy. Doesn't always work out that way.
To that point, David, of whether or not the Fed likely they're going to be cutting in September, but now the debate is, do they go 25 or 50? If you think we're closer to the risk of recession than a risk of reacceleration, do you think the Fed needs to go 50 basis points in September?
I think I would like them to go 50 basis points, but only if they can message this as being part of a normalization, because honestly, rates are in the wrong place and they need to get to normal at a reasonably rapid pace. I think that's what they ought to do. But they have to message it that way, because the problem is that, as Steve said, if the Fed cuts 50 basis points and does it because they are scared of the unemployment rate going up too fast, it won't speed up the economy. It'll scare people. It'll cause people to halt business decisions. It will cause people to wait for lower rates before they borrow money. It will reduce the income for people, the $6 trillion in money market funds out there. So the problem is there's a J curve in monetary policy. When you cut rates, it actually hurts the economy before it helps it. And that's why they've got to be very careful here. Of course, the truth is they shouldn't be in the wrong place. They should never have raised rates as high as they did, and they should try to get back to a normal short run interest rate of somewhere in the range of 3.5% to 4%, and just stay there. But I do think that I think the employment report for August will be crucial here. I do think they ought to do 50 basis points, but I think they ought to try to message that as, look, the economy is fine. We're just getting back to normal at a reasonable clip here. We're not going to draw it out over a year and a half. We'll try to get back to normal a little bit more quickly than that. If they do that, I think they're managing the situation well.
Well, David, I guess what I don't understand then is if we're 50 basis points and we have more room for that, is that not sort of like an emergency cut? I mean, isn't 50 on its own something you wouldn't do if the economy is healthy?
Well, we didn't really have an accelerating inflation problem at all in 2022 and 2023. The inflation rate was coming down after June 2022, and we saw plenty of 50 basis point rate hikes. So I think the Fed has to sort of desensitize the economy a little bit, say, look, just don't freak out here. The big moves in short-term interest rates don't seem to have much impact on economic variables anyway. So let's just get back to normal. But it's a close call. I mean, the thing that I wish they'd started earlier, because then they could have started based on, look, inflation is steadily heading back towards 2%. We're very confident we'll hit 2%. We're going to take off the brakes here. They ought to start doing that earlier, because I agree that if it looks like they're doing this as an emergency rate cut because the economy's in trouble, that's only going to weaken the economy. So they have to be very careful in messaging. I think it should start with expressing some confidence based on today's numbers that the inflation situation is on the road to 2%.
Steve, just final word, 30 seconds, your view on 50 basis point rate cut in September.
There's no way, given the dots, they can message that properly. Remember, this is a committee that went from several rate cuts before the end of this year to 125 basis points. And now we're talking about, in September, let's go 50. What are the dots going to do? Are we going to get a number of people on the committee to turn around and say, oh, I'm going to reduce the dots? Are they going to be able to do that? They don't talk about the dots in that direction. So the reality is, if they go 50 basis points, then the question is, what changed so much that you only had one, that now you have two, and you're doing it all in one shot? And then what happens to the additional meetings for this year? So the reality is, like we saw the other day when the unemployment rate came out and the market moved, people jumped to the idea that when the Fed cuts rates, a recession begins. And this is a mistake. Typically, when the Fed has cut rates in the last 4 cycles, it's because we had a credit crunch. There is no credit crunch unfolding. And therefore, there is no real need to move aggressively in monetary policy.
Steve Ricchiuto of Mizuho, David Kelly of JPMorgan, thank you both. We love having you on, especially together. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Haqqez. Yahaira.
Hi, Lisa. As you were discussing, U.S. inflation eased on an annual basis for the 4th consecutive month, keeping the Fed on track to lower interest rates when it meets in September. Core CPI increased 3.2% in July from a year ago. That's the slowest pace since early 2021. While the monthly reading rose 0.2%. The print showing inflation is still broadly on a downward trend alongside a softening job market. And U.S. mortgage refinancing surged last week by the most since the early days of the pandemic as borrowing costs continued drifting lower. Mortgage applications climbed 2.8%, the largest advance since the first week of June. Meanwhile, the rate on a 30-year fixed mortgage eased 1 basis point to 6.54%. And shares of Kellanova are rising in the pre-market, up 7% after Mars agreed to buy the maker of Pop-Tarts, Pringles, and Cheez-Its for nearly $36 billion. Kellanova was spun off from Kellogg last year, and since 2020, Mars, which is known for M&Ms and Skittles, has scooped up snack bar maker Kind's North America business and Nature's Bakery as part of an effort to expand its snacks portfolio. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, setting you up for the rest of the week, you're watching Bloomberg Surveillance. Markets still trying to figure out what to do with the CPI print. Right now, counting you down to the opening bell. Here's the trading diary for the rest of the week. Tomorrow, we'll get retail sales plus another round of jobless claims, plus Walmart reporting before the market opens. We'll also get Fed speak, and this time, yes, it does matter, from Musalem and Harker. And on Friday, we'll get round out the week with housing starts, UMich sentiment, and more Fed speak from Chicago Fed President Austin Goolsbee. We are about 24 minutes away from the CPI print that hasn't showed that much more clarity, but at least doesn't seem to derail the Fed from cutting rates. Danny, what's your takeaway from what we saw today?
That this market was all just doved up into it, that we went so far on this bond market. The JPMorgan client survey showed the most net long on Treasuries since the start of the year. So we went into this decision kind of expecting something soft. We got something basically in line, hence the market reaction.
Anne-Marie, just taking a step back, it sort of raises this question, how much more clarity do we actually have right now versus before?
Well, when you have Steve Ricchiuto and David Kelly on, I don't really walk away from this conversation with any clarity. Steve Ricchiuto was talking about the fact that the Fed shouldn't be cutting. David Kelly saying they should be cutting, and he'd hope that they would go 50 basis points. If that were the case, though, think about the timeline. 50 basis points going into a U.S. presidential election where people already are trying to politicize this. So I have not a lot of clarity, except for the fact that I think, given the report here, housing costs, that's going to be a huge talking point Friday when Kamala Harris comes out.
I can imagine so. Coming up tomorrow, don't miss this, Lisa Shallett of Morgan Stanley, Tom Steyer of Galvanized Climate Solutions, Harry Sommer, CEO of Norwegian Cruise Line Holdings, and Joyce Cheng of JPMorgan. This was Bloomberg Surveillance.
Day one at the Cincinnati Open, Frances Tiafoe stormed into the second round with a straight sets win over Spain's Alejandro Davidovich Fokina. 6 aces, 4 breaks, and 18 winners for Tiafoe, while 23 unforced errors told the story of the match for the Spaniard. The American closing out the victory on his 4th match point to move on. And don't forget, you can watch all the action live on Tennis Channel. Our daily coverage starts at 11 a.m. Eastern.